There's the man of the evening, Don Durrett. Alex, if you'll bring him on up, we'll get him introduced. So, first of all, for those who may be listening for the first time, you need to understand why Don's the guy to turn up the volume for. He's not just a juggernaut within the gold and silver space, but he's also a market veteran who's experienced a lot of prominent cycles. He's also well studied monetary and political history, which makes him a great insight for macroeconomic forecasts and understanding a lot of that esoteric nuance that goes over a lot of heads of a lot of folks. And we've had Don on about 4 or 5 times now, and I can say that his calls tend to be quite good. So I do encourage everyone to dial in and listen up. Don's also an established author with a variety of books, ranging from well-being, politics, and of course, gold and silver. In particular, he wrote the book I'm holding in my hand right now, How to Invest in Gold and Silver, a complete guide with a focus on mining stocks. And to date, this is the only book like it of its kind in the market. You can find Don contributing to many well-known authorities from Seeking Alpha to Palisades Radio, many more. Of course, Don doesn't just write books. He has a very popular newsletter in the gold and silver space. Of course, that's goldstockdata.com. All new members get his gold and silver investment book for free. And this is a newsletter that I'm personally subscribed to. It's a great resource for anyone looking to find those 10 baggers in the gold and silver space and stay appraised of the situation and the day-to-day news and information that comes out in all of these companies and the big updates that you need to know. You can kind of stay ahead of the game and all that kind of stuff. It works for me. And there he is. Don, how you doing? It's been a while.
Hey, thanks for the intro. So can you hear me?
Awesome. Yes, sir. Loud and clear. How you doing?
Awesome. Yeah, I'm doing good. So, I wanted to say a couple things for the intro. First of all, my book, I've tried to keep it updated. So the first edition came out in 2010, and I just released the 9th edition. Came out this month in February. So it's definitely the best release ever. It might be the last release too, because I think when I was going through it this time, I was like, I think it's pretty much done. Nine updates is enough. I mean, I could see myself update maybe in 2 or 3 years, but maybe not. Probably the ninth might be the last one. But yeah, it's definitely a good book for anybody that owns gold and silver mining stocks. You're definitely going to learn something new. And anybody that's thinking of buying a gold and silver miner, it's definitely something to look into. The other thing I want to mention is since our last spaces, I created a Substack. So if you guys go to substack.com and search for my name, Don Durrett, you'll see a whole bunch of lists in there. 90% of it's free. The way Substack works is you can basically donate money to authors. And so people wanted to give me money for putting content up. So I created a way for people to do that. So some of them have a lock on them, which means you have to pay for them. That's for the paying subscribers, but 90% is free.
Yes, sir. As an author, when do you find the inspiration or the necessity to feel like it's time to update the book? Kind of what gets you there?
Annual. So it's usually January. So January rolls around and I think, do I need to update it? Do I not? And it had been a couple years and I knew it was time. So yeah, January was the key month.
Very good. Well, Don, I think the best place to start today is with your very own newsletter. You published an article on January 30th. It was titled Why Gold is Going Higher in 2023. And you lay out how we got here. And first of all, it's an excellent article. I read it a couple times. And, I'd really like the audience to hear what you had to say. You outlined a lot of this in our very first interview together. But I'd like to go back and do it again. It was a long article. I don't expect you to recite the whole thing, but at least maybe we can break it out in 2 or 3 chunks because, it's important to understand how we got here. And I'm a personal believer in what we're doing and why we're here today. And I believe that time is running out. And so I think it's important, especially for anyone new who doesn't know anything about this and who's just kind of popped in to listen, to know what's going on and to know why we got here. So if we could start there, I mean, you really pinpoint Reagan as a major catalyst for our modern debt problems, which is becoming more and more well known as the everything bubble, which you think is more apt to call the Mises bubble. So what was Reagan's great mistake, and how was he instrumental in this modern monetary crisis?
Yeah, that's definitely, this is a good question. I mean, we can really dive into this a little bit. So the article is about 10 to 12 pages long. And the reason I wrote it, I just said, because I consult for a couple private equity companies. And one of the guys who's, he basically understands gold. He understands the whole space, right? And he was asking, I don't know, we were having a meeting, a Zoom meeting, and said something about gold going higher, lower, whatever, what's going to happen here. And I kind of started laughing because I'm so bullish. It's like, lower? What do you mean lower? And he goes, he kind of got angry, and he said, "Why are you so confident?" And I was kind of taken aback by it, because he understands gold. He understands the space. And it's like, wait a minute, this guy's not bullish? He doesn't see everything? He doesn't, how, from my standpoint, I see gold, and we'll talk about why. That's the whole purpose of the article. I see why I think gold's going higher. I've been doing this since 1991. I've been following gold. And so I understand the space really well. I turned 20 in 1980, so we can start there with Reagan. I didn't really, I was too young in the 70s to know kind of what was going on there, how America switched from being a mercantilistic country from the 1940s. After World War II, America dominated the world basically in making stuff, because Japan was wiped out, Europe was wiped out, so America had to make everything. We were exporting goods, in the 50s and 60s, and we were dominating, and so we were a mercantilistic country where we had a trade, we didn't have a deficit, and so we had a trade surplus, and so we were basically just generating wealth, real wealth. And then in the early 70s, basically it started in the late 60s, the dollar was pegged to gold. And most of us don't even realize that. It was pegged to gold. So you could actually turn in your dollars and get gold and get back in gold. That's what France did. France basically broke the buck. France basically said, okay, here's a bunch of dollars. Give us some gold. That was part of the reasons why Nixon flipped over. But the other reason why is because everybody was catching up to us in the 70s. Europe and Japan were starting to export stuff, and Asia was starting to kick in to gear. There really wasn't much of Korea then. There wasn't any China. There wasn't, no Vietnam, none of that stuff, right? A little bit of Japan was exporting. It was kind of the early days there, the late 60s. And everything really started to turn. So the 70s, again, I didn't live through the 70s, but I know it historically. That was the period of kind of the malaise of America. It was kind of the turning point for when America was the dominant player. And we had low inflation, 50s and 60s, low inflation, high global, real wealth generation. So we get to the 70s, and all of a sudden something broke, right? Energy prices went up. We were no longer this dominant player. And we had, two serious recessions, one in the early 70s and another one in the late 70s. They're both related to oil. And then we get to the 80s. And this is where it kind of gets interesting, is that the conservative movement that we know today did not exist until the 1980s. There was no, far right. There was no, there's no far left, no far right. Everything was somewhat centrist. I mean, you look at Nixon, right? Nixon was a Republican. You go back and look at what Nixon did. He was basically very, very moderate, right? So we didn't have, the Republican Party. We didn't have this kind of what we see today as the Republican Party did not exist in the 1970s. And so we get to this, and so the 60s and the 70s was all America trying to find its way, not only economically, but it was trying to find its way socially as well, culturally as well. And we got lost. I mean, literally got lost. I mean, basically when Kennedy was killed in 63, and we killed his brother Bobby in 68, that was kind of the end of the American, I don't know, model of creating, opportunity for everyone, basically. That's kind of what the Kennedys wanted to do. And the Republican Party was being born at that time. I'm getting into politics because it all kind of delves into, you have to understand all this stuff. You're going to understand the price of why gold's going higher. So the 60s was kind of the last era, if you will, of where America was not necessarily going to be socialist, but again, the conservative right didn't exist in the 60s. So it was either going to be this moderate dream where everybody kind of has opportunity, where you don't have a 1% crowd. Again, it's not really socialism per se, but it's more of a we all get along kind of thing. Racism kind of goes away. We all try to get along, right? But that was kind of the something that was people were trying to do in the 60s, but it didn't work. It didn't work, and so we went through the 70s and we got through these economic traumas. And we lost our basically our global dominance on exporting, and so everything changed in 1980. Okay, so we got to 1980. Do you want to ask? You want to interject something before I go to the 80s? I wanted to preface that.
No, sir. Keep on.
Great. I wanted to preface all this stuff so we understood. When Reagan came into office in 1980, kind of the backdrop of where we're at. So what Reagan was faced with. So Reagan, Barry Goldwater ran for president in 1964, and he lost to Johnson. He was the first somewhat quasi-conservative, but he was basically on an island. There wasn't a lot of people that really supported that whole. We didn't even know what that movement was, but he was kind of like the father of the conservative movement. But it was basically what it was doing is foaming. It was forming. It was kind of. It was marinating basically from 1964 to 1980. And then Reagan gets into office, and Reagan basically said, with his kind of brand of conservatism, which is what we have today, he basically put America in a new, he created, and most people don't realize this, but he created what we have today, which is the American economic model. The Democrats haven't changed it at all. I mean, look at, Biden got into office and look what he didn't really change the economic model. Nobody's changed it. Reagan basically put this model in place in the 80s. But the model, it actually had cultural overtones to it, because it was a very meritocracy type of thing. That I want to, if you work hard in America, basically you can get rich. Reagan basically was a low tax guy, low tax, low regulation. We're going to we're going to make everybody rich. But they had something called supply side economics, and supply side economics was that if people were getting rich, then it was basically, which was the supply side, the supply is kind of the corporation. We're going to support the corporation. So corporations are going to rise, and it's going to lift all boats, and everybody's going to get rich, kind of thing. And that's kind of what we've been doing ever since. But in tandem with that, it was like, forget about debt. What's important here, because when Reagan got into office, we had less than $1 trillion in debt. And so it's like, forget about debt. We're going to use debt to generate growth. We're going to use debt to generate our higher standard of living. So Reagan got in. There was no such thing as a $200 billion or a $300 billion deficit during a time of economic growth. So Reagan, the 80 and 81 we saw the recession. 82 is when we started growing. Well, Reagan never slowed down his deficit spending, even though from 82 to 88, we had a high economic growth and everything was going well. He continued the deficit spending. So he put the deficit spending in motion, and the politicians loved it, because it was like, oh, okay, we can have deficits. It's not hurting us. We can, it's like a corporation. You have debt, but you pay it off. No big deal. This is the new way. We're going to use this. We're basically going to use debt to, again, prop up our standard of living and prop up our economic growth. During the Reagan era, the focus was 3% growth or better. Now we're down to 2% or better. And so you got more bang for your buck back then. If you had a deficit of $300 billion, it would be like today having $3 trillion in deficit. It's hard for me to go into why, but you basically got more bang for your buck. that little deficit was basically generating a lot of economic growth. And then Reagan lowered taxes, and he basically supported, and then we had this big defense spending. His defense budget really kind of exploded. So he was funding tons of defense spending, which was helping economic growth. And so basically with Reagan, the bottom line was this, is that Reagan basically brought in globalism. It's like, okay, corporations, if you want to leave America and you want to go make your stuff in China, that's fine. We're not going to penalize you. Do it. Fire as many Americans as you want. We don't care. And that was the beginning of globalism. And nobody said a word. And the middle class started getting hollowed out because all those manufacturing jobs started leaving America. I mean, you go to the Midwest and you can drive around. You can see, all of those plants that, basically that were in the 50s and 60s. They're all, dead right now. Dayton, Ohio is a good place to drive around. It's like that in the 50s and 60s, Dayton was doing great. Detroit, kind of some of those other places in the hot Ohio and Michigan areas. And that was the beginning of the end of America. And so we went to a quasi-globalist deficit spending model. So we're going to use globalism to basically prop up our corporations, but simultaneous to that, we're going to lift up. So even though the middle class was losing their jobs, we're going to get all this cheap goods from China are going to come in because we have this globalist model. So now we have cheap goods from all around the world, which is going to prop up America's standard of living. But that was a dream, if you will. It didn't really work. It's worked for the top 10%, but it didn't work for all of America. It didn't work for the middle class. So what we had to end up doing was, once we started that globalist model, it was really hard to turn it around because, and we never have. Now there's talk of it. Trump was really the first person to basically question globalism, first president to question it. Now we all are. It's gotten to the point where we're all recognizing that the middle class is getting hollowed out, and we need to make stuff at home. And now the Chinese are making all this stuff that we need. Like they make all of our medicine, right? They make so much stuff that nobody else makes. And so we're dependent on them. And they're our enemy. I mean, it's kind of insane, right? And so globalism 100% was a bad idea. If Reagan would have said, look, we're going to do globalism, but we're going to do it smart. We're only going to allow corporations to make like 90% of their products in foreign countries and 10% in America. That would have worked great, right? That would have kept, middle class humming along. But we didn't do that. We kind of did an all or nothing kind of thing with globalism. So basically what's happening to America through globalism is America's getting poorer. So right now, as we speak today, I would say 50% of Americans are basically living paycheck to paycheck. And that is a big reason
75.
why.
75.
Okay, I said at least 50. I said about 50, right? So families are living paycheck to paycheck. America's getting poorer, right? America's getting poorer by and large. And that is a direct result of not generating enough wealth. And that's a direct result of globalism, which started in the 80s. And we've never stopped it. We haven't turned it around, and nobody's really talked about it. I was really disappointed in Trump in that I thought, because when Trump ran, he really talked about all these jobs leaving America, all of these manufacturing plants leaving America. So I thought he's going to bring the jobs back. And I was excited. I'm going, wow, this is great. He's going to bring the jobs back. But he never did. NAFTA was a joke, right? The unions wanted, they were all supporting NAFTA. And I'm just going, what's going on here? This makes no sense, because the way they rewrote NAFTA really didn't bring any jobs back to America. The way that they did it, the way the bill was written, it was like the corporations still had the power to prevent it. That's that. Basically, my point is that globalism hasn't turned, and it doesn't look like it is going to turn anytime soon. People talk about it, but we're not seeing any evidence of it, right? So globalism, that was number one. The hollowing out of America, making America poorer. And simultaneous to that, the key here is the deficit spending that Reagan basically showed politicians, because he did it during a time, that's why I call it the von Mises bubble. So von Mises was an Austrian economist who was very, very famous. He's kind of known as one of the legends of economics overall. All his writings have basically shown, for instance, he is recognized as, his articles in the 1950s are recognized as some of the most famous writings in economics. And what he wrote, and when I put it in my article, was that if you create a deficit basically through debt, if you generate debt using basically money that you borrow through debt, that becomes a bubble until you pay it back. And so you can't, in other words, you don't get, there's no such thing as a free lunch. That was kind of the von Mises argument. There's no such thing as a free lunch. You can't just, as for governments, he's not talking about corporations, but it kind of applies to them as well. But as far as governments go, if a government goes out and, throws $100 billion of debt on its books or whatever and creates a bubble, they have to pay that back. And if they don't pay it back, eventually it's going to create some type of a negative effect. There's no free lunch. That's the argument there. And so now we're up to $31 trillion, and that's not free. You can't just add debt and expect to not have. And he called it a bubble. He said eventually those bubbles have to burst. They have to either be paid back, or they burst. And so that's, and his other argument, I'm not an economist. I know the surface level of his argument, and his argument makes perfect sense. But his argument is that it creates a lot of negative impacts for the economy when you create these bubbles. Basically, when you print money through debt and not pay it back, and there's a couple ones. One is you end up mispricing assets, and we're seeing that in spades, right? All the housing, you take interest rates down to zero, which is what the Fed did. Von Mises says no, you can't do that, because when you misprice assets like that, you're going to create fallout. Again, no free lunch. That's kind of the Austrian economic, that's their mantra. You got to follow the rules. If you don't follow the rules, you're going to get bitten. So America is gotten to the point now, and this is kind of my argument, that America is fading. So again, okay. So let me go through the '90s really fast, and it really starts in 2000 when the dot-com bubble bust. So through the '90s. So Newt Gingrich came into office in '92. We had this big wave of Republicans in the House, and Newt Gingrich was the head of the House. And Newt Gingrich said, "We can't have deficit. We can't have all this debt. Debt is piling up, and we're doing all this deficit spending." And right then we were having a recession right then in '91, '92. And so people are starting to that's when you have a recession, your deficit starts to expand. And so that was the genesis of the first, that we tried to push back in the early '90s, in the mid '90s. And Newt Gingrich basically said, we're going to balance the budget. We can't do this deficit spending. He was basically in the Austrian school. He's basically saying what Reagan did, we can't keep doing that forever. We're going to bankrupt the country. But simultaneously, and Bill Clinton didn't have enough. He basically went along with the Republicans because he didn't have much of a choice. He could either veto them and fight them, or kind of go along. He decided to go along with kind of what they did, and so we ended up balancing the budget in '98 and '99 because of those policies that Gingrich was doing. '93, '94, '95. A lot of times it takes years before those things work their way through. And then we had economic growth from '93 to '98, '99. So we had economic growth. So you had economic growth, and then you had the Gingrich stuff in there, and we balanced the budget. And that was a good thing. But when the dot-com bubble, now we get to 2000, and we're getting close to the reasons why gold is going to go higher. So we get to 2000, and the dot-com bubble bust. And when the dot-com bubble bust, it was like all of that mispricing. Remember, we had those early deficits from like '90 to '97. Those deficits were pumping up the economy and making all these, and making it easy for the economic growth was overstated, if you will. We overstated it. We weren't using the kind of the Austrian economic model there in the '90s. So we're getting more growth than we should have had. And so we get to 2000. We had the dot-com bubbles. Remember, the stock market, it literally crashed. It crashed before 9/11, and that crash was the end of the idea that deficits are bad. after 2000, it was like New Gingrich was out of power. The people that were back then in the mid 90s, they didn't, it's like nobody had a voice anymore. So deficits, they took off again in 2001. So then we had a year after, so we went into a recession. So we had the bubble bust, and then in 2001 we had 9/11, and we had a recession. So once that recession hit in 2001, we basically started up deficit spending again, and we've never stopped. But the bad thing is that people remembered that back in the 80s and the 90s, that deficit spending was good for the economy in the near term. So in the near term, you could basically have deficit spending and you could generate jobs, you could generate growth. And we created, the first bubble we had was, of course, from 2002 to 2006 was the housing bubble. That housing bubble was because of low interest rates. We had these low interest rates, anybody could get a job. And then we had all this stimulus money that was going in. So Wall Street had all this cash, and they basically say, okay, you want a housing loan? They were giving housing loans to people that didn't deserve one, people that didn't have income. They called them ninja loans. If you guys remember the ninja loans, no income. I forget what exactly it stands for, but it was basically, it doesn't matter. You don't need it. You don't need to have income. We'll let you buy a house. I mean, it was insanity, but that was all the mispricing. But that was the kind of the signal that America was on. It was basically the economy could no longer stand on its feet, couldn't stand on its feet, and needed stimulus to grow. And it didn't matter if the economy was growing. If the economy was growing, they had to keep stimulating it or else. And then 2008, we had the great financial crisis, which was basically a fallout of all these mispriced assets, right? We mispriced all these houses, and then we had all this free money, and everything kind of, people lost a lot of money, right, in 2008. And so America, and then you would think, coming out of 2008, you would have thought that the Fed would have realized that all that mispricing of assets, low interest rates, and the high stimulus was actually a dangerous thing and a bad thing. But Hank Paulson, he basically said, look, the only way we're going to avoid a meltdown, this is in 2008, the only way we're going to avoid a meltdown is to bail everybody out. We have to bail everybody out. And the only way we bail everybody out is to print money. So we basically printed, I think Paulson asked for $700 billion, but it ended up being a lot more than that, all of the bailouts. So that was, and it worked, right? So we basically threw all this money at it. The recession was over in June of 2009. And in June of 2009, from that point all the way to 2020, we basically did the same thing that we did in the 80s and the 90s and the early 2000s. We basically stimulated the economy so that it wouldn't fall, it wouldn't crash. Simultaneously, that we just kept adding these huge deficits. I mean, during Obama, he was averaging $1 trillion, because he got into office in 2008. He was averaging $1 trillion a year in deficits. And now $1 trillion deficits are normal. Back in the Reagan era, it was 250 to 300 billion. So we basically have tripled the deficit size. And they were doing this. Remember, during Obama, we never had a recession. So he was in office for 8 years, averaged $1 billion a year, and never had a recession. So what does that tell you? It means America was addicted to debt. And so since we were addicted to debt, we've mispriced all these assets. And now we have a big problem because 10% of our corporations basically do not deserve to be alive because the only reason why they exist is on low interest rates. So low interest rates and so now we're up to 5% of interest rates. So I've never been more bullish ever because at 5%, the economy cannot grow. It can't. It's impossible. It can't grow. So we have to go into recession. And what blows my mind is that the stock market's right now at 4,000, S&P's at 4,000, and yet we're still raising rates, and we can't grow there. So we have to go into recession. Doesn't anybody connect the dots, right? So I'll stop there. I could talk for another 30 minutes.
That's great. That's a great run.
I'm going to do a little quick housekeeping. I know there's a few people joining in. We'll put up people a little bit later if you have guests or questions, specific stocks you want to talk about. I don't want to keep people waiting too long. If you want to, you can write your question below. You're welcome to do that. And Liberty, you can go ahead and continue the conversation a little bit.
Yeah, sure thing. So that's a good segue. We'll talk about the 5% interest. I will tell you, I'll be honest that I got the Fed dead wrong. I didn't think that they'd get rates this high. They made a fool out of me. And so where are we now? I mean, how does this go from here? Do they start reversing or do they hang on and push us over the cliff? I mean, what's your base case? I mean, you've been pretty good at predicting what they do next. So, we got the debt ceiling increase and we got these high rates. I mean, where do we go next?
Yeah, where we go next. So let's talk about that. But before I do that, I want to just do a quick little kind of tie it up what I just went over there. So basically, what I was expanding upon it was the idea that all of this debt from 1980 of less than $1 trillion to $31 trillion today has caused the everything bubble. So basically, our assets are overvalued right now. Our houses are overvalued. Our stock market's overvalued. Our bonds are overvalued. Everything's overvalued. And so the only thing the Fed can try to do here is try to prevent that bubble from being basically bursting. And the only way that they can do that is through having their tools, because they know their tools. They only have two tools. Tool number one is low interest rates. Tool number two is printing money. And they don't have either one of those tools. So the reason why they've been raising rates is not to fight inflation. It is kind of, sort of, but it's more to get their tools back. The Fed cares the Fed cares much more about GDP than they do about inflation. They like inflation, actually. Inflation, everything is, we got growth and everything's there. Some people, people that don't have, middle class gets hurt, but Wall Street's doing fine. I think they'll be absolutely ecstatic at 3%, inflation, but it's GDP that scares the hell out of them. They do not want to have negative GDP because of the bubble. And if the bubble burst, who knows what's going to happen, right? We almost had a meltdown in 2008. It's kind of the same scenario here. And what's the reason why I'm so bullish on gold? You talk about where we're going. We're going to get there. We're going to answer that question. But if you look and see what's happening globally, economically, it's really bad for America. And remember, all of our assets are overvalued. And so America needs that dollar. We need our dollar to stay strong, and we need our dollar to be used in international trade. But the war in Ukraine has really flipped the whole thing. Because now China, who has basically been our economic competitor, and China, they have ambitions to be the global economic leader. I mean, that's literally their goal here. They're very ambitious. I mean, look at the One Belt Road. Look at their investments into Africa. Look at their investments into South America. This is a country that wants to be the global dominant leader in economics. And now it's come out. Now they're like, fine, you don't want to be our friend anymore. Trump was the first person to basically say, look, you guys aren't playing fair, and he put on the tariffs. He's the first one. Obama gave him a free pass. George Bush Jr. gave him a free pass as well when they were growing. Do whatever you want. We're going to, it's okay. And so now China is basically making allies with Russia. They're making allies with India. They're making allies, with a lot of countries, Indonesia, a lot of African nations. So the BRICS Plus is basically manifesting right now as we speak, and that is going to be very detrimental to America going forward. So how in the world does the Fed, we talk about what's next, how in the world does the Fed juggle all of these issues? And if they fail at any of them, gold's going to go to the moon. So, I mean, so issue number one is how do they prevent the economy from imploding? We cannot have a hard landing. If we have a hard landing, who knows how many bankruptcies we have? Who knows how many mass layoffs we have, right? So they have to prevent that. And in order to prevent a bubble bursting or prevent a hard landing, they're two tools, right? They got to inject money. So that right now they're doing QT, so they have to flip over to QE, and then they have to lower rates. And everybody's like optimistic that they can do this. And I'm like, well, it's not going to be easy. And the odds are against them pulling this off. So first of all, the whole raising of rates, the reason why you said that you didn't think they could get to 5%, right, was that you thought the economy was going to break. Something was going to break. it hasn't broken yet. And the reason why it hasn't broken yet is because they injected $4 trillion. So they injected $4 trillion, and all that cash is floating around, and it's allowed the economy to basically get a few more quarters in. A few more quarters, but this January bump in the stock market is a total illusion. It just allowed them to get a few more quarters before everything basically falters. But I'm with you. I think once the interest rates got to like 4%, they broke it. It's their economy now. I thought they should have stopped at 3% and focused on QT and let QT, quit printing money basically. Quit printing money and let inflation come down that way. Don't use interest rates to bring down inflation. If you do that, you're going to crash everything, and that's what they're doing. And from me as a gold investor, I'm like, yeah, this is great, raising rates. You guys are out of your mind. You're going to go to 5, 5.25, 5.5. Are you crazy? You're going to break something really big, and this von Mises bubble is going to pop, and you're not going to be able to restart the economy, and gold's going to $3,000. And that's what's going to happen here. I think that I've been saying that the stock market is going down. It's going to go down. Right now it's at 4,090. So to get a new low, you have to go down about 14%. So we're going to go down. The stock market is going to go down somewhere between, and I've been saying, 10 to 15%, but I think it's going to go down 15 to 20% because we're up at 4090. You go down to 3900, then it's a little different story. But now we're up to let's say 4100. You're going down 15 to 20. So that's a big drop, and that drop's going to take at least a month, and it might take 2 months. And I think the selling is going to begin. My feeling is that sometime in the next 4 to 6 weeks, the selling will begin, and it'll take 2 months to get to the bottom. And then once you get to the bottom, all hell breaks loose, basically. Then this is my other prediction for the years. I believe this is the year the Fed loses control. And in my lifetime, the Fed has never, ever lost control. The Fed has always been able to do whatever they wanted to do. Lower rates to zero, print money. They've never had their hands tied. I really feel that this year they're literally going to have their hands tied, and there's nothing they're going to be able to do, and because they're going to be trying to juggle so many things and prevent so many things from breaking, they're going to lose control. Now, I don't expect a crash. Even though the stock market is going to go down 15%, I don't. That's only 3,200. That's not a crash. Some people are saying they think the S&P is going to go to 2,500. Now that would be a crash. I don't even think we're going to 2,800. I think 3,000 will hold, 3,200 will hold. That's not a crash. And I don't see unemployment going over 15%, over 20%. A depression era type of thing. But what's going to happen is that the economy is not going to come back. That's going to be the ugliness. The ugliness is that this isn't a normal business cycle. It's not going to come back. And that's why people are going to be afraid. That's why the fear trade in gold is going to manifest. Because this everything bubble is going to pop. The one that Reagan started is going to pop. And gold is going to benefit from that.
I agree with those numbers on the stock market. Those have been my base case numbers for a long time. That's a great take, by the way, on everything. I appreciate the well thought out answer there. What do you make of all of these war drums and stuff? I got to be honest with you. I've been out of things for a while, and I am not in the day-to-day happenings like I was several months ago. So what I know really comes down to the headlines I read that the casual person might read, right? You go to the Drudge Report and you see that we're all about to die. It's Chinese balloons and it's tanks in Russia and Ukraine. And how much of this global division is going to play into the gold price? Or do you think it's purely the sovereign monetary crisis, or do you think that all these war drums are going to ramp up their own degree?
Yeah. I do not foresee a world war. I do not foresee a war with the U.S. and China, U.S. and Russia. Now, I actually study the future. I mean, you guys can go and see the books that I've written. I've been studying the future since 1989. Now, how many people study the future? Not that many. I have a very diverse set of sources that I use, and most of the sources I use, a lot of them are esoteric, and so most people would say, so my confidence that there's not going to be basically as this world war is not. It's not really based on logic per se. It's not based on analysis. It's more based on what's coming, what the future entails, if you will. This isn't the right platform for me to go into and explain why we're not going to have a war. It's like I said, it's very metaphysical in nature. But me personally, I'm not worried about a war, world war, war with Russia, war with China. I'm not worried in the slightest bit. I do not think it's going to happen. Now, one thing that could happen would be China invading Taiwan, but I don't see that as a big shooting war. It's more of a China basically coming in and saying, just taking it over, kind of like when the U.S. took over Grenada. It's kind of a one-day thing, one and done. There's nothing Taiwan can do to stop it once they decide to take over that island, and I think they will sometime in the next 3 years. But I think they're going to wait. They're going to wait until, because I think they have the same analysis that I'm doing about the problems that America has. I think they're going to wait until the U.S. basically is kind of broke, if you will, and that we're not funding our military, and we no longer have, our focus is more internal. I think that's the way to say it. I think China's going to wait until the U.S.'s focus is more internal. Right now, we're not. We're still both internal and external. And you could make an argument that we're more external than internal. And so once America turns inside, because the economy won't restart, and basically we have problems everywhere, I think that's when Taiwan gets taken out. But again, I don't see it. The war drum thing isn't. I think you're misreading kind of what's really happening here. I think this is really all about money. And isn't it interesting? Most wars are about money, right? I think this is all about money. It's all about corporations and country, and each country basically is supporting their own corporations. So it's basically an economic war that's happening globally right now. I think that's what's unwinding, and America's in a bad position because we are vulnerable in so many ways. For instance, as countries de-dollarize, dollars are going to flood back into America, and as they flood back here, it's going to create inflation. And I think that is the reason for the CBDC. The whole purpose of the CBDC is, I believe, to create a reset. So the CBDC is actually going to be a new dollar. And so the old dollars will have to be turned in to the new dollar. And they'll use the CBDC as a new dollar. Once they do that, all the external dollars are going to be orphaned. And you won't be able to bring them back to America. They will no longer exist. They'll probably kill the existing dollars within 6 months. And they won't let anybody to bring the foreign dollars in. So all those foreign dollars that are outside, all those euro dollars, America will say, have fun, those are yours. Do with them whatever you want. And that will be kind of the global reset. And I think that's going to happen in the next 3 years. So, and that's all part of this bursting of this bubble. The whole part of the bursting of the bubble is the reset. That's the reason why gold's going higher, is because the bubble's bursting. We are going to get a reset. And America has all these vulnerabilities, mainly globally. Even though we have $31 trillion in debt, most of our problems, believe it or not, is globally, because we owe all these foreigners all this money. Now, if the money was internal, like Japan, most of their debt is all internal. So they could basically make their internal people take a haircut pretty easily. But if America tries to do that, if we try to make foreign holders of our bonds take a haircut, I mean, that would basically blow up the dollar. All hell would break loose, under that type of a scenario. Basically, it's a partial default, right? And then in tandem with that is that America has created, because of the Ukraine war, we've created a lot of economic enemies. The BRICS Plus now, if they form a coalition, America is no longer kind of the number one trade partner. So there's that. And then simultaneous to that, you have the whole NATO problem that America is trying to kind of maintain, because that's how we get our influence over Europe. But I think that America in Europe, that whole relationship is basically, it's dying. I don't know how long it's going to take to die, but I think it's busy dying right now.
Don, I hear your sentiment, and I want to ask you a question as an investor. You made an interesting comment at the top of that article that we started with here. You had mentioned that when you started investing in 91, you started accumulating shares in a gold mutual fund.
Yeah.
All right. And you collected over 5,000 shares with a $60,000 investment that now has a negative cost basis because you've collected more than that in dividends and capital gains, and you've never sold a single share.
That's correct.
So as an investor, can you speak to that and tell me, where did you get that much confidence, right? And how did you resist any temptation not to sell a single share in 30 years?
Oh, I've never considered selling a share. Never crossed my mind. The reason why is because the bull market, let's back up. Why did I buy a gold mutual fund in 1991? Right.
That's actually a follow-up question.
That's a good question right there. And the reason why is because, well, first of all, my grandfather gave me $10,000, and that was the only investment I even thought of doing. I would have done it earlier. So in 1989, remember I said I've been studying the future since 1989. So I read a book in 1989, and the book said that America was basically entering its demise. It was in its sunset period. And it was no longer going to be a global superpower. And I believed the book. And I was like, oh, America's going down. So if America's going down, what should I invest in? I sure don't want to invest in the stock market. Now, a lot of people will laugh and say, look at how much money you would have made in the stock market. But I'm comfortable with my gold and silver because I know in the long term, heading towards retirement, the gold and silver are going to be fine. But the stocks and bonds, and maybe not. So that was the reason I originally bought. My grandfather gave me 10 grand in 1991. That was my first initial 10,000, and then I ended up investing another 50,000 over over 10 years. So, it was never going to sell it. Yeah.
Well, I wanted to connect the dots because this might sound silly, but I know people in my personal life who will frustrate me because they'll say things like, well, I don't remember how I felt back then. That was 20 years ago. And that makes no sense to me. How do you not remember how the hell you felt? You were there. Right? It drives me crazy when I hear stuff like that. But when I read your articles and I listen to you talk, you don't have that problem. You remember how you felt. And the bridge I want to build here is, what is your sentiment today versus 1991?
Yeah.
And what kind of opportunity might I have that you had in 91, and how do they compare?
Yeah, that's a great question. First of all, I'm dead serious. I absolutely remember when I got that check, that $10,000, there was nothing else I wanted to invest into it but gold and silver. I mean, it's like, it's 10 grand. What am I going to do with this money? 100%. I remember that was the only thing. My sister at the time was a stockbroker. And I basically I asked her to find me a gold mutual fund. She found it for me. She told me the fund to invest in. It was Franklin Funds out of California. And that was the one that I basically, I actually invested, well, the capital gains, I actually ended up with 5,200 shares today. So yeah, I won't sell it until we get to $3,000 gold at the earliest. So, okay. So now how do I feel? How do I feel about, my investment back then? So back then I knew I was early, 1991. I absolutely knew I was early. I had no idea when, this so-called sunset of the American era was going to happen. But I could read the tea leaves. I was negative on what America was doing economically. I actually told my dad right around 1985 that America was going to go bankrupt if we kept doing with Reagan's deficits, because Reagan was basically 250, 300 billion deficits for 6 years. He left office. It was $2.7 trillion. He almost added 3 trillion in 8 years. And I was seeing this, so I was actually already kind of, even before I read the book that America was basically, the American era was ending, I was already somewhat negative. But I knew in 91 it was early. It's not going to happen anytime soon per se, but I'm going to go ahead and start investing in gold for when it does happen. and I didn't see until we got to this into this century after 2000. So all through the 90s, I didn't see this end of America. I thought, I did see the debt. The debt was piling up, but I didn't really feel that. I was still buying gold, investing in gold mining companies with this mutual fund, but it wasn't until right around after 9/11 hit, even the dot-com bust, I still didn't really feel, because when the dot-com bust happened, gold was only $250, which is kind of crazy, $250. So I was investing when it was really cheap. So then the dot-com bust hit 2000. I still was not, okay, this is it kind of feeling. But after 9/11 happened, I knew that was a change. That was kind of a change point for America. And then I started thinking about, okay, maybe this is when America is going to start to falter. The economy. So we went into recession. But even 2001, 2002, 2003, I started. That's when gold started to go higher. That's when the fear trade kicked in, and I actually thought that that gold was going to go back then from 250. I actually thought it was going to go to 2000. It did in 2011. It did what I thought it was going to do. I did think it was going to go to 2000, but I didn't. I was starting to get bullish when the great financial crisis happened, 2007 and 8. I started to think then that was the period when I started getting really bullish that gold and silver are going to basically really, really take off here. Something's going to break and gold's going to go up. But it was a false positive. We did run to 2000. We went to $1,935 in gold in 2011. And it was a false breakout. It didn't last. It was like we went up to that high, and it was up there for maybe a month, maybe 3 months, and then we started falling. And then late 2012 and then 2013, gold and silver just crashed. And so that one surprised me. And then I didn't really know from so let's say 2013 all the way until March of 2020. I didn't really know when gold was going to, when the economy was going to falter. I always felt that it was going to happen. It was coming. And it was just a long, long wait. And that's kind of where we're at now. It wasn't until January of this year, last month, that I basically realized that it's gold's time. Now's gold's time. It's nothing. Now we're finally here. So what I started in 91, basically, it took 20 years, 21 years. So now we're there. Right now, in my opinion, this is the gold bull market that I've been waiting for.
The last time we talked was the 6th of November. And you thought in that interview that by the time we reach the end of that month, we'd know if those September lows would mark the bottom. And you and I never had a chance to follow up and see how you felt about that. Yeah. But now that we're here, when we've run the course that we have, do you think that those bottoms will hold?
No way. Wait. Are we talking
about the gold and silver stocks?
Oh yeah, they're going to hold. Yes, the lows in the gold and silver I think are definitely going to hold. If you're talking about 1615 on gold and 1750 on silver, and I don't know exactly when I became bullish that they were going to hold. I don't know if it was November, December, January. It was definitely December. Could have been November, but I basically have turned bullish on the bottoms. As a matter of fact, I do my Friday night recaps, and in my Friday night recaps, I always put what my bottoms are going to be, my targets for the bottom. And I recently had to move them up a little bit, so I had to move them down. Because silver crashed from 24.50 all the way to 22. It traded under 22 this week, and so I had to lower my targets last week for silver to 19 to 20. So the low is 1750, and I'm right now. I think that $19 is going to hold, and definitely 1850. But I think 19 will hold. So I don't think we're going to retest those bottoms. And then gold, the bottom is 1615. Some people say 1619, but basically 16 in the teens. And I think that we're going to go somewhere down to 1720 to 1750. I do not think that 1800 will hold. And so I'm hoping that 1720 and $19 hold. That's what I'm hoping. But it's nasty. If the stock market's going to go down 15%, and I think it is, gold and silver are going to get hit over the head. There's no doubt about it. And so I've basically been on the sidelines waiting. I got 6, 7, 8 stocks that I'm going to buy at the bottom. There's no reason, as far as I'm concerned, there's no reason to buy them now because we're going down a lot lower. So if you're waiting to buy something, I think now is a good time to wait. So those are my bottoms.
I happen to agree with you completely. I see the same things on the charts. I think those levels hold as well. And if we do break them, I agree with you. It might just be a little bit, but they'll slingshot back up. I see the same thing exactly the way you see it. So I'm actually very encouraged by this right now. Let's actually use that to segue into some companies. If anybody wants to talk to Don and bring your questions, you're more than welcome. He's happy to answer them. He's the perfect guy. So feel free to, there's no such thing as a bad question. Just raise your hand and we'll get you up. Let's talk about first Majestic. Do we have any good news from Jerritt Canyon? And are we still hoping to be surprised by lower than expected cost, or what's the scoop out that way?
We have excellent news, and it's insider news, I think, because First Majestic gave guidance of Jerritt Canyon of $1,800 AISC, and you have to pad that about 200. So basically, they're saying we're going to lose money on Jerritt Canyon in 2022. I mean, it was really nasty, and their stock price is down to $731 as we speak, because people think that basically Jerritt Canyon is broken. If it was fixed, they'd be trading at $14. Well, the good news is I talked to them in Vancouver at the VRIC conference, Vancouver Investor Resource Conference, the last week of 2 weeks ago, last week of January. And I talked to them for 30 minutes, and they think it's going to be fixed in the third or fourth quarter this year. And I said, so your AIC is going to drop down to $1,500 because currently their AIC guidance was $1,800. I said, you're going to get it down to $1,500. And he nodded his head very affirmatively. Yes, we are. So if they do that, so the only issue here with First Majestic, right now you're basically getting Jerritt Canyon for free at the current valuation. I mean, even if they took Jerritt Canyon offline, I think it's worth more, especially if silver prices go up. I mean, it's worth more than their current market cap. Jerritt Canyon is basically is hurting the company. It's hurting their valuation right now because their silver mines are fine. Their AISC on their silver mines, I think are around 15, 14, and then their break even is around on their silver mines around 19. So they're making free cash flow on their silver mines. It's just they're getting killed on Jerritt Canyon. So this is actually a growth story. I mean, most people don't realize this, is that they're actually giving guidance. So in 2020, last year, 2022, they did 31 million ounces of AGEQ. This year, they're expecting 35. So they're going to add 4 million ounces of AGEQ this year. It's not priced in at all. Then in 2024, it's going to jump to 45 million. So they're going to go from 31 to 45 in 2 years. At 45 million ounces of AGEQ, and again, they got to generate some free cash flow at Jerritt Canyon, of course. They're going to have $1 billion in free cash flow. So $1 billion of free cash flow, if they got valued at a 15 multiple, it takes them to $15 billion. Their current market cap is 2. That tells you what kind of leverage it has. It's basically 7 basically a 7-bagger at $50 silver potentially. And silver's not going to stop at 50. It's going to keep going higher. But that's the kind of leverage this stock has. I mean, yeah, remember I said, you don't want to buy a stock now. You want to wait until the bottom. So I would wait, and you're probably going to be able to buy First Majestic under $6, which is insane. So one of the best investments I ever made was I bought 10,000 shares of First Majestic in January of 2009, basically at its bottom. So I paid somewhere around $1.20 to $1.30, I believe, a share. And then it went to 28. So it was almost basically a 25-bagger from 2002 years, from 2009 to 2011. It was basically about a 25-bagger. So the same setup is kind of happening now. So if this thing goes down to, say, $6, I don't think you're going to get a 25-bagger out of it, but you're probably going to get a 10-plus bagger. So it's kind of the same setup where so I'm very bullish this stock. I think the risk reward just totally makes sense because, again, worst case, they basically shut in Jerritt Canyon and, the stock goes down to $4 and gets totally beat up, right? And then silver prices start rocking and rolling and they're generating a bunch of free cash flow. I talked about their debt. And they basically said that it's not a problem. We don't have high interest rates. We have very, very, very low interest rates on their debt. So they're not worried about that. So I'm very bullish. There's not very many quality miners. Well, let's put it this way. I mean, if you look at how many silver miners that there are available for institutions to buy, you can count them on one hand. There is not that many. When I'm talking about silver producers, you got Hecla, you got Coeur, you got Pan American, you got Endeavor Silver, but Endeavor, they're they're not big yet. And then you got First Majestic, and then you got Hochschild, but Hochschild has a lot of issues down in Peru. So, you got Aya, but Aya's in Morocco. There's just not that many choices for institutions if they want silver exposure. You got Fresnillo, of course. That's a play. But, basically there's only about 5 of them. So they're all going to do fabulously well. Companies aren't going to want to really buy Silvercorp, because of Taiwan. That's going to be kind of probably a no-go for a lot of these institutions. And so First Majestic is going to benefit. First Majestic and Hecla and Coeur are going to benefit big time when silver breaks out because people want silver exposure and you get 2x leverage. And everybody knows you get 2x leverage.
Right. Hecla seems to be performing very well relatively. It went up 90% from the low at 341, and it's only down about 10% now in the last few weeks. It's about 12, 13%. What say you on that, on the relative strength compared to the rest of the sector? Is that coincidence or is something going on with Hecla?
So Hecla is another stock that I have a big position in, and I really like the company. And I don't like their management team per se because I don't think there is as shareholder focused as, say, a First Majestic. They have no problem, adding debt and growing. So if you're constantly growing, you're constantly spending money, and it's kind of hard for you to, be shareholder focused. What I like about First Majestic is they'll buy a mine, but then they'll pay that debt off, and they'll reset themselves, from a shareholder standpoint. So Hecla's not a company that people, you get really excited about their management team per se. But what I like about them is I like the location of their mines, the quality of their mines, and the fact that institutions are going to buy them. So it's kind of you want to own Hecla and Coeur, you basically, okay, these companies, historically have not done that well. but they do well in bull markets, and that's what you have to recognize. They do well in bull markets, and the reason why is because that's when Wall Street brings in their money. And Wall Street, when Wall Street says, okay, I need some miners, they're going to buy the big names. They're going to buy companies that are 500 million and above, and especially $1 billion and above. And there's just not that many plays that are, let's say I want some silver exposure that are 500 million market cap and above. They don't want to buy these juniors that have, $100 million market cap, 200, a lot of the Wall Street funds or whatever. So they don't have many choices. So Hecla and Coeur are going to benefit big time. The other thing that's nice about Hecla is it looks like they fixed their problems, and their acquisition, when I say their problems, is this kind of company almost went bankrupt a few years ago. And their acquisition, their share price, I got down to like $1.50. But it was touch and go for a while there. But their acquisition of Alexco was a game changer for them. So here's an interesting one. A lot of people that are listening probably don't know, is they paid more to pay off Alexco's, but pay off Silver Wheaton's silver stream on the Alexco than they did for Alexco. They paid Silver Wheaton $125 million to make that stream go away. And that was just 25% of production. That's how valuable these streams are, because the contract is that Wheaton only has to pay them like $4 an ounce for 25%. So the free cash flow on that 25% was just outrageous. So they gave Wheaton $125 million and said, here you go away. So now they own that entire mine. They own Alexco free and clear. They get 100% of production, and it's going to be an economic mine. And so that lowered their overall cost. And so they're fixing that right now. It's going to be in production by the year end. And I think that Alexco mine is going to be a big winner for them. I think it's a big change. So they're giving guidance, this year of 16 to 17 million ounce production of silver, and they have a bunch of gold to go with it, because I think that's just silver alone. And then they bought a gold mine, Klondex, in 2021. Now the Klondex mine has been a bit of a disappointment. But once gold gets above 2,000, I think it's going to do really well. There's a lot of gold mines out there right now that are that peak companies own, that are kind of high cost. They're not generating a ton of free cash flow at, say, $1,800 gold. But once you get over 2,000, those mines suddenly look really, really valuable. And Alexco has one of those. That Klondex mine, I think, is going to generate some nice returns for them over time. But their cost, so let me throw some numbers at you, show you their cost. I have their debt at $550 million, which isn't terrible for a company of their size. They have a market cap of 3.5 billion, fully diluted. So, it's not super bad. And once they get that down, say get it down to 200 million or so, because their free cash flow, they can handle that debt as long as silver doesn't, go bad. But, they're producing around 16 million ounces of silver, and they should get up to, I think they're going to grow to, just on their current mines to 20 million. And then if they do some acquisitions, Hecla is a company that could they like to grow. There's no doubt about it. They like to buy companies. So Hecla could become a monster company. It really could. I mean, they're currently at 3.5 billion, but it wouldn't surprise me if they get north of 10 billion. I mean, this is a company that has a lot of potential. And I have their break-even cost right now at $14, which is a really big drop from where they were at. So they've really fixed their cost problems. I mean, if you can buy a silver miner right now that has, $8 margins, free cash flow margins, that's pretty darn solid. Gives you a lot of room for error. They're somewhat pricey though. They've jumped. I'm showing them as a free cash flow multiple of 39, and so anything that's over 25, anything over 20 is kind of pricey. So people like Hecla right now, but I think it's going to go nuts. So I have them at 90 million, generating 90 million in free cash flow currently. And so they're not a cheap stock. I wouldn't buy. I would probably buy it just because for diversity. It's printing right now is a 3-bagger at $100 silver, but I'm very conservative on my pricing. I'm not. Well, actually, that's not accurate. That's at a 15 multiple. So if we double the multiple, then it would be a 6-bagger. So it's not. It's actually.
That's it.
I would. Yeah.
Joking.
But okay. Some people, believe me, most people aren't happy with at $100 silver. If I'm only going to get a 6-bagger, I'm not buying it. But yeah, you got to own quality companies like this. Another thing is that you want to own companies that are going to participate. When silver goes from $30 to $50, you want to make sure that you own companies that are going to participate. Because, if you have a drill story, if you're overweight some of these drill stories, they might not necessarily participate because their value is all based on future drill success, not the current silver price. They got to find more silver, right? And so, or a company that still needs to develop a mine, it might not participate. Not nearly as much as, like the Heclas and the First Majestics and the Coors. Those companies, we know they're going to participate. I'll give you a story. Back in 2011, I did not own Endeavor Silver. And I was watching First Majestic just go nuts. And then then Endeavor, of course, was doing well too. And I was really angry at myself because I did not own it. And I put it on my watch list. Wasn't going to buy it. I don't chase stocks that are pricey. And I put it on my buy list, and I actually didn't get it until I think like 2016. I had to wait 5 years before it got cheap enough for me to buy. And now it looks great, and now I'm glad I own it. I own it for this bull run. So I have FOMO for producers, if I don't own a producer and it's pricey, it really upsets me because I've had all these years to buy them. I own about 45 silver mining stocks, and of the 45, I don't know, I'd say about 20 of them are producers. So I own most of the silver producers, and that's the reason why, because I want to own the companies that are going to participate, and I don't know which ones are going to be successful. Now, let me give you guys a really good story. So I bought a company called Crocodile Gold, I think back in like 2006, somewhere there. A long time ago, prior to the run-up. And Crocodile Gold, they got taken out by a company called Newmarket. So Crocodile Gold was a mid-tier producer in Australia, and their management was terrible. They didn't do well, but they had some pretty decent properties with some pretty decent, resources. So it's like, I'll take a flyer on that. I'll buy that. Then a company called Newmarket took them out, and then Newmarket got taken out by Kirkland Lake, and then Kirkland Lake went in, drilled a couple holes, and found the Fosterville mine. So I ended up getting basically when Kirkland Lake took out Newmarket, they were actually a pretty cheap stock. They weren't super pricey then because they had not discovered Fosterville. And then Kirkland Lake, they basically exploded to the moon, and then Kirkland Lake got taken out by Agnico Eagle. So here's my point. My point is I had this lowly old mid-tier lazy company that nobody liked called Crocodile Gold. It turned into a 10-bagger. And today, Agnico Eagle is one of my largest holdings. And here's the kicker. My cost basis is almost at zero because of the dividends and it will be at zero at this year. So I'm getting significant dividends from Agnico Eagle. So you never know where your winners are going to come from. That's my point. Because you don't know who's going to buy who, and then who's going to discover what. That's the reason why I like to own a lot of companies, because it's really hard. It's really hard to know which stocks are going to be your big winners. You would have told me Crocodile Gold was going to turn into a 10-bagger and then be worth all this money, I would have said no way.
All right, so we have a few different questions from the audience or the viewers. One of them is more of a macro question. It's related to the dollar milkshake theory. So what are your thoughts on that? Where are we at it, if you believe that? From Brent Johnson.
Yeah, I'm glad somebody brought this up. So I've never been a believer in the milkshake theory. The milkshake theory is that the U.S. dollar will be the last man standing, and that the U.S. dollar will always kind of maintain its strength because of the euro dollars and the U.S. economy, and the fact that the U.S. dollar is the global reserve currency, and countries like to make loans in dollars, and so if they make loans in dollars, it's always going to create demand for dollars. The dollar's never going to die. The dollar's always going to be kind of the king of the hill kind of thing. And I hear Brent a lot of times saying, "Oh, what's going to replace it?" And he's got a good point. I mean, nothing's going to replace it. Yeah, it's king of the hill. Nothing's going to replace it as kind of a new global reserve currency. I agree with him there, but I don't believe for a second that the reason why the dollar went from 95 to 114 was because of the dollar milkshake theory. I think it went from 95 to $1.14 because the Fed raised rates, and the two other biggest components of the DXY, Japan and Europe, did not raise rates. So you had this trade where basically people were they're selling those bonds, buying U.S. bonds because it was pushing up. I mean, when you can make easy money, on these 4% on the U.S. debt, and you basically were getting 0.25 in Japan. That's a huge return. And then it was the same thing in Europe. Europe, they didn't. So once Japan, so here's kind of my point. Once Japan and Europe finally started raising rates, it crashed from 114 all the way down to 103. And so that just shows you that it's not that theory is not so cut and dried. Now maybe he's right. Maybe it's going to turn around and go to 120. I remember when it was at 114, people were saying it's going to 120, and to this day, people still think it's going to go to 120, 130. I'm not in that camp at all. I'm confident that it's getting ready to roll over and die this year. And I'm saying it in these spaces, and you guys are going to remember I said it, of course. I think it's going to bounce during this sell-off somewhere between 106 and say 109. I definitely expect it to go to 106. I mean, technically, if you look at the chart, technically at 106, it's either resistance, and it's going to it's not going to get above 106, but if it gets through 106, it'll probably, run all the way to 109, somewhere in there, 108, 109. So, I think this is going to be the very last bounce in the dollar. And when I say last, I mean the last ever historically, because by the end of this year, I expect the dollar to be at 95. And by the end of 2024, I expect it to be below 88. Those are my targets. And the reason why is because I think that we're in a de-dollarization process. And if you're in a de-dollarization process, that means the dollar should lose value. It shouldn't gain value. And that's my expectation. And also, I think that the U.S. economy is going to lose a lot of its mojo this year. And as it loses its mojo, fewer people are going to want to make loans in dollars, because the whole purpose of making loans in dollars is because the dollar is strong. And if the dollar's losing its mojo, no one's going to make loans. This is foreign loans, foreign banks. So if foreign banks aren't making loans in dollars, then that's going to, you have less. And then dollars flooding back to the U.S. as well. So I'm bearish the dollar after this sell-off in the market. And the sell-off in the market, the dollar's going to go up to 106 to 109, because that's what it always does. It always goes up in a crash. Dollars and bonds is where you kind of want to hide, until the crash happens.
All right, we have another written question here from Ducati.
Wait. Before you give that question, I want you to tell me what you think the dollar is going to do. Since we agree on so many things, I want to see if you agree or disagree with me.
I agree with you on the technicals. I'd say that's about right too. I think long term that is the play.
Much lower, right?
Much lower, yeah.
Okay. Okay. You're not a fan of the dollar milkshake either. Okay.
I appreciate it. I think it explains a lot of nuance, and it has been right. I mean, even Brent says himself he only had to be like 40% right for it to be relevant, and I think he got at least that much right. But long term, it's to be seen. I mean, it starts getting really complicated.
I think that Brent is still expecting 120 plus. That's his target, 120 plus, and I just think
about that.
I think that I just don't see that happening. Okay, let's go to that next question.
Next question is from Ducati. He wants to know what's holding Silvercrest back. They executed well in construction and getting to commercial production. Is it just a matter of waiting for them to start processing the higher grade ore?
I think part of it has to do is they're not cheap. People, I'm bringing it up on my screen right now. I like Silvercrest. We need to see what their costs are. We need to wait and see if they hit their targets. Now, we know they're hitting their target on production. They've already ramped up to basically their feasibility levels, 7 million ounces a year. But I have their break even at $14, which is the same as Hecla. So we need to see if they come in at 13, 14, 15. And every single one of those numbers is going to change their valuation. They seem to be getting priced right now at kind of my number, at 14. So at 14, they're valued at a multiple of 20, which is kind of pricey. So they're not cheap. But they have a long way to run, though. They're cheaper than Hecla. I have them about an 8-bagger is what I'm expecting them to be. So I see them, it's definitely a stock I own and I like a lot. This is another one. Remember I said there's not that many silver plays out there. So they're going to benefit from the institutional money too. So they're definitely not cheap, the 20 multiple. So I have them this year, they're free at current prices. They're generating around 39 million, but that multiple is misleading because that 20 multiple is all based on the current silver price. So if silver goes to $30, that multiple just shrinks. You know what I mean? Because their free cash flow goes up. The multiple is all based on free cash flow. So silver prices go up and their multiple shrinks. That's where you get the exponential growth. So what happens is that as the multiple shrinks, then they become cheaper, and then people buy it, and then the multiple gets bigger. And so that's what you're looking for. You're looking for multiple expansion, and it's all about free cash flow, in my opinion. That's why I focus so much on it. And so, yeah, I think we got to wait and see if they hit their number. If they hit their number, Silvercrest, they look really, really strong here. I have them in my top 25. I like the whole story. I like the exploration potential. I think they're going to grow to 10 million ounces. I think they're going to end up buying another company. So they have a good balance sheet, by the way. 50 million in debt, 50 million in cash. So this is very unusual. They actually built a mine, and they're producing 7 million ounces, and they only have $50 million in debt. That's solid. And plus, they have 50 million in cash. So what's going to happen? They're going to basically end up with zero debt and about 150 million in cash pretty soon. And once that happens, they'll go out and buy another company and then take that cash and inject it into this new company. I expect Silvercrest to acquire somebody this year and next year. They're ready to buy somebody right now, I think. Because the reason why is you don't want to stay a single mine company. When you're a single mine company, you're vulnerable. It's hard to stay. It's very difficult to remain a single mine company. You just get taken out. And so I want Silvercrest. I'd love to see Silvercrest merge with like Go Gold, a Discovery, another strong company. That would make so much sense to me. Another one they could merge with would be Aya. That would be another great, some of these single mine companies, they really need to merge with somebody else and basically protect themselves, protect their shareholders. So yeah, I think Silvercrest right now is very vulnerable to getting taken out. And that would break my heart if they got taken out, because, you know, there goes a 5, 6, 7, 8 bagger off the charts, right? So, but who's going to take them out? The key here is who takes them out. If it's a big major, that would be bad. But if it's another mid-tier of equal size, that would be good, actually. I don't mind that. That would protect them. So on the whole, I think we just need to wait and see if they hit that target of my target of $14. They need to hit the 14. Now the $14 would be $8 cash cost, and basically an AISC around 11 maybe. Yeah, we want the AISC to be around $11.
All right, so we have one more question coming in from Painting Tahoe, and then after that, Jim, if you have one. So Painting Tahoe says, Don, your tweets are amazing. Question: are you planning to hold your mining stocks through the coming recession and add to your miners? I would take a wild guess and say absolutely yes.
Yeah, I'm not a trader. I don't, basically sell stocks just because I know that I know gold and silver are going down and no recession is going to happen. So what I do is I try to improve my portfolio and strengthen it by opportunities, buy stocks I don't own. So I have about 160 positions. I have a lot. I said I had about 45 silver positions and 110, 120 gold positions. So I'm always trying to find stocks that well, let me tell you, a little bit about my portfolios. But the answer to your question is, yeah, I'm holding and adding. So I talk about this in my book. I basically use a pyramid approach where the bottom of the pyramid is lower risk stocks. So I have on the bottom of my portfolio, I have 30% into non-individual companies. So in other words, 30% of my cost basis is physical silver, mutual funds, and ETFs. So I have physical silver. I forget the percentage. It's about 8%, I believe, of my cost basis. Then I have 3 mutual funds and 4 ETFs. And so, so that is my foundation. That's 30% of my foundation. There's no individual companies there. So, because each individual company has risk. You just don't know if even if it's Agnico Eagle, it still has a lot of risk. You just don't know how it's going to perform. Agnico Eagle, I mean, if the Fosterville mine had a cave in tomorrow and it would drop, 10% overnight, maybe 20%, right? So you never know on individual stocks, but mutual funds and ETFs, they're going to go with the market itself. So that's my foundation. Then the next 30% is mostly high quality producers. So I want to be overweight producers because I know that they're going to participate in the run, and so I want that. Now, they're not all 30% are producers. There's some near term producers there, and there's some quality developers there that I'm confident that they're going to get built. Then the final 30%. And then, 30, and then the last 10 is basically cash. I don't have that much cash, or something else. But the next 30% is your high risk stocks. And so I'm actually, and those stocks I have small allocations in, like 0.25%, right? And so these have small allocations, but they all have really solid upside potentials, and I have a lot of those. So the bottom half, you just had 8 stocks, right? And then the next portion up, the next 30% is maybe 20. And then you got all of these others in the high risk zone. And the high risk zone is basically your drill stories. And I don't like drill stories per se. I think these are like pure exploration plays that are non-optionality. And you want to have only about 5% of your portfolio in these. These are like your lottery picks. It's like you don't know if they're going to be a success or not. And then you have your exploration optionality plays, and these are companies like Golden Tag that are sitting on, I forget how many million ounces of silver they have, like 100 million ounces of silver. They're basically optionality plays. So you're buying the silver in the ground very cheap, and you're just waiting for it to get repriced in. And then the next one after that is your development stories. And though I've had a lot of bad luck, I think that optionality is better than development as far as risk reward. And the reason why is because in development stories, so much can go wrong. The first thing that can go wrong is they can have, trouble financing the mine. They can't finance the CapEx, and so they just get stuck. There's a lot of companies like Minova, Minova in 1911. I mean, they just can't, they can't finance the CapEx. Go West. I mean, they finally finance theirs, but it's taken them forever, and they get stuck, and they're just so cheap. Treasury metals, they haven't got there quite yet, but and some of them take a really long time to permit, a really long time to get there. Like Bonterra, we're going to wait a couple more years for them. A lot of these development stories take a long time. Ascot finally got financed. Skeena, for instance, they're not going to get into production until like 2026. I mean, you have to wait and wait and wait. And then while you're waiting, they dilute. And then if they get taken out, whoever buys them gets the money. I found that you only make big money on about 20 to 25% of if you're very selective on development stories, you still only make money on like 20 to 25%. The risk reward isn't that good. But, and if I had to do it again, I would probably be more selective than the way that I did it this time. I'm just, crossing my fingers that I have, about 50 really big winners of all, that I've, we'll see how it all unfolds. But again, on your risk stocks, don't do high allocations on your risk stocks. Expect to lose money on all your high risk stocks.
All right, Jim, you had a question?
Hi, good evening, Alex. Hi, Liberty. Hi, Don.
Hey, Jim.
Just had Don and I traded tweets back and forth about his ideas for lows coming up on silver a day or two ago, and I just wanted to weigh in with my perspective. I trade just the price with futures, and silver's had about a $7 run since September 1st. And in our business, a lot of times we like to look at a 50% retracement as maybe being about it. Well, 50% of a $7 move would be about $3.50. And right now we're about $2.50 off that high, off that 24.50 high. We finished right at about $22 today. So I'm not quite as negative as Don is. I would see silver has been underperforming gold on the pullback, but it outperformed gold on the way up from September 1st. Gold didn't make its low until December. So I guess that gold's had a $300 move up and it's had a $100 sell off. That's 1/3. And silver is just $1 shy of 50%. So I would think that, in my opinion, that you could be looking for lows in silver. Maybe they held. We only had one up day this week in the silver futures contract. The rest were down days. Gold performed a little bit better. So I think we could maybe do a little bit better, holding a little bit higher than maybe what Don's looking at is what my attitude is.
Okay, Jim. Yeah, so I have a question for you. So back in 2008, which really was the last time that we had you could say March 2020 as well. But if we could look at both of those. So we could look at March 2020 and then in 2008 when we've had, because what I'm expecting here is, I don't know if it's going to be worse than March 2020, but both of those periods, when you had big sell-offs, if you will, in the markets, the stock market, because I'm expecting the stock market to go down at least 15% and maybe 20. So, and it's gonna occur over at least a 1 month period and probably a 2 month period. If that happens, if you have that big selling in the markets, what you're telling me is you're saying that silver is basically going to decouple. And the only way that silver decouples is if gold decouples too. It's not going to decouple on its own. And so you're saying that gold and silver are going to basically catch a bid here and basically hold. The markets are going to be selling off like crazy, and gold and silver are going to hold. Now, I would love to see that, but if you look at the 2008 and the March 2020 sell-offs, that didn't happen. So why do you think it's going to happen this time?
Well, Don, March 2020 was COVID, okay? And it affected every single thing, all right?
Right.
I don't expect that scare to come into the market again. I expect the stock market. If you follow David Hunter a little bit, some people like him, some people hate him, that kind of thing. But he's looking for a little bit of a rally for the next couple, 3 months, something like that. I wasn't giving you my silver target of 22 or 21 holding in conjunction with the stock market. I don't really care about the stock market in my business, but I'm trying to answer your inquiry, your question here. March 2020 was COVID. It's not a black swan. I don't.
What about? Okay, so let's ignore that one. Let's go back to 2008.
All right, 2008 was a mortgage crisis. All right,
yeah.
13% of the people that had mortgages stopped paying their mortgages. They were the subprime part of the mortgage, if you remember that.
Yeah.
And it affected every single thing. All right. But shortly after 2008, then we rallied to 2011 and we rallied to $50. So
right. I'm just talking about the initial selling, just the initial wave down, because that's what I see coming.
Those great big things. You know, you get nobody had ever in mass ever. You can talk to the real estate guys. Nobody had ever lost money really in real estate by buying it until people stopped paying their mortgages. So, and then that showed people you can have a loss in real estate. So that's kind of what happened in your 2008 category. It was about a year-long event, 2007 to 2000.
Right. So, yeah, silver went all the way down to $7. I forget where it started, but it was in the teens. It was brutal. I mean, so and gold as well. Gold went, I think, down 800. It was under 1,000.
Yeah, it's been brutal since. I mean,
right? No, yeah. My
right.
point was the initial wave of selling. Gold and silver got dragged down.
Yes, they did. Everything got dragged down in both times.
Right. That's the only reason. That is literally the only reason why my target is $19 on silver, because
That's fine. I don't see a COVID type event happening again. It could be a World War III, you know, that there's some political things going on that I'm sure Liberty's watching.
No, we don't. We're not going to need any type of significant black swan or significant event to push the markets down 15%. The only thing we're going to need is Wall Street basically saying, the markets are overpriced, and they just start selling. It's basically a 1987 type, October 1987 type event. Nobody expected it. It's just one day everybody just started selling. Yeah, that's what I expect.
We're still off the highs though in the Nasdaq. The Nasdaq had a tough year in 2022, and even the S&P. You know, the S&P was down about 18. The Nasdaq was down around 28, and the Dow was down around 10 or 11.
Yeah, so, we're way off the lows and the highs.
Right.
The key here for me, the key here is that the earnings expectations for this year. If you look right now, the S&P is valued at 19 times earnings. 19. That is very, very pricey.
Sure.
And it's basically priced for a very, very soft landing, if a soft landing at all, no landing basically. So my point is that once the markets realize that we're not going to get a soft landing, they're just going to start selling, and it's going to be really hard to stop. And so once that happens, I'm hoping, I'd love for 21 to hold, and gold holds at 1,800. I'd love for that to happen. But the odds favor a drag down.
Okay. Well, we'll see. I just wanted to give you that, that 50% retracement. Gold's at about 33. Call it a third, $100 off a $300 rally, and silver's still $1 off a 50% retracement. So I'm not quite. I had asked you, if you remember, I tweeted you the other day, probably Thursday, and I just wanted to get what your idea was. I was just asking.
Okay. All right. Very good, Jim. Thanks.
Thanks. Bye.
All right. I've got one for you, Don, and then we'll go to the stock sultan. So I want to talk to you about Silver Tiger. We talked about this last time. They're down about 32% from the recent highs. Looks like they had to raise some capital. So my question is, are we still excited about Tiger grade and all these 9,000 grams per ton discoveries they're making? Or is this like a hype machine? Because I don't think I own anything in my entire portfolio that excites me and scares me equally as much at the same time. I mean, this one kind of freaks me out. What do you think?
I like it a lot. I like the drill results. I like the size of the mine. I like the CEO. He's got a lot of experience, been around a while. I don't think he's going to give this company away. I really get the feeling that he wants to grow this into a big company. I think he wants the respect of his experience. He wants to be known as somebody that's successful in this business. He's a character. I think he could be a comedian if he wanted to. He's quite the character. But I think that he's got enough experience to pull this off. I think the risk reward totally makes sense. They have a permit. They're going to start mining soon. I think it's about 12 months away. They're going to release a PFS really soon, and then after that's out, part of the reasons why they raise this money is to get ready to make a move towards production. I think they're going to be in production in 2024, and then it's just going to grow from there. I think this stock is really cheap. I mean, if you look at that drill hole they had, it was about 2 weeks ago, 6 meters at 2,000 grams silver equivalent, 44 meters of 720 silver equivalent. That's a massive hole. I'm definitely a fan of the potential here. I just think the risk reward totally makes sense. But again, what I mentioned earlier, don't have high allocations on stocks like this. We don't know if they're going to work or not. It's like, put as much money in as that you can lose. That's how you have to treat these gold and silver miners, because there's a lot of volatility, and there's no reason to. I've seen people do it all the time. They'll put like 5% of their allocation in a company like this because they think it's going to be a 10-bagger. Don't do that. Don't be that person. I would not put more than 1% of your total cost basis in a high risk stock, because it's just you're just gambling. You're taking too much risk. We don't know. We have no idea if Silver Tiger is going to be a success or not. But I definitely want to own it. I think this is 100 million plus ounce property. The CEO thinks it's 150 plus, but he's probably hyping it a little bit. But I definitely think it's 100 million plus. It's currently about 60 million ounces, but it's definitely with the latest drill results take it. I don't know, probably north of 80 million. But it's a big property. They got a lot of targets. And the thing that's nice is they know right now they have where they're drilling. They know where to drill right now, basically. So the head grade is, it's pretty amazing what he's expecting on his head grade. I don't know if he's going to be able to achieve it. But he's thinking that they're going to mine like 500 gram per ton head grade in the second phase. They're going to start off pretty low grade, but the phase 2 is going to be high. It's basically going to be a high grade mine. So yeah, I think it's an exciting story. I don't really see a lot of red flags. I see it, as far the capex is low for the first mine. It's very low. You're gonna have no problem funding it. I don't see them adding a lot of debt. I see them generating free cash flow. So it's it looks pretty darn solid. Silver Tiger does to me.
Thank you, Don. I appreciate this, sir. Stock Sultan, you're up, my man.
Hey, good evening, everyone. Thanks, Don, for all the work that you put out. And I had a question. It kind of touches on the conversation you were having a bit earlier with the gentleman. If you think that the S&P will be, taking a more hard landing in 2023, don't you think that the Fed will be forced to call back their rate hikes or possibly start a U-turn? And wouldn't that cause, maybe that's what sends gold and silver to their new all-time highs?
Yes, that's exactly what I think is going to happen, because they don't want to cut rates this year. They would love to be on a plateau, at least till October, November, right? So if they're cutting prior to that, in other words, because their last rate hike is going to be either in April or May. So if they do that, let's say their last hike is in May, and then June, July, August, and then if they have to turn around and lower rates in June, July, or August in the summertime, that's going to only say one thing, that the economy's in trouble. And it's exactly what you just said. If they do that, if they pivot, that's going to be really good for gold, because it's basically going to show that the Fed is kind of lost control here. They can't do what they want to do, because if they're lowering rates, we know inflation didn't go away. So if they're lowering rates, then they're trying to prevent basically a problem. So that means a problem arose. And I think that they're going to lower rates potentially in the third quarter is my expectation, basically in the summer. I think there's a really good chance they'll lower rates in the summer, and I think it'll be an emergency meeting, and I think it'll be directly because GDP is negative, and they basically don't want the economy they don't want to lose control of the economy, and they're like, I think they're going to come to the realization that, look, we're going to have to lower rates we're going to have to lower them. So why do we do it now? Why wait? They waited to raise rates. Why do they need to wait to lower them when they know they have to lower them? Because the longer that they wait, the more the economy goes in the tank, right? So that's why I think in the third quarter they lower rates. And my feeling is that once we get to March, and it could happen in February. I mean, it really could. Could happen next week. Once we get to March, I think all eyes are going to be on the economy, and we haven't had to look at the economy, because since COVID started, they basically injected so much money that and stimulated so much that the economy's been fine. But this when the economy goes into a recession and people start getting laid off, that is a really bad thing. And so we've avoided that. And so I think that all eyes on the economy is going to start in March, and then then we start getting the selling, March, April, May, and once we get to June, that's when I think the window opens for them to cut.
So do you think the crash happens first, then the cut?
Yes, absolutely.
They would never try to preempt it?
No, they would never preempt it. Absolutely not. The chance of them it would make no sense for them to preempt it. They wouldn't be able to explain themselves because of inflation, right? They've been fighting inflation for almost over a year, almost a year now. So if they did a preemptive cut, I mean, what would that say? It would make absolutely no sense. So the only thing they can do is wait. They can basically raise and then plateau and then wait. That's all they can do. They can't preempt it. They have to wait for the economy to falter. Because if the economy begins to falter, then they have a reason to cut. As a matter of fact, there's going to be pressure on them to cut, but not until you get these mass layoffs. Not until you get like a Jim Cramer event. You remember the Jim Cramer where he said these guys know nothing?
Yeah.
Until we get that, until people are screaming on TV, these guys have to cut rates. people are losing their jobs. People are losing their houses, right?
Mm-mm-mm.
And I think that type of talk is going to start in March. And once we get to the summer, I think people are going to start screaming at the Fed, you got to lower rates, you got to lower rates. People are losing their jobs. Yeah, we're going to hear, people on Wall Street are going to be saying it. Politicians are going to be saying it. I'll be really surprised if what I just said doesn't transpire, because that's exactly what I'm expecting.
All right, thanks, Don.
Yeah, thanks for your question.
All right, I have a question. It looks like there's going to be a merger between Yamana is getting a buyout. So what are your kind of thoughts on who gets what and who gets the better deal out of that buyout that most likely is going to happen?
Yeah, you're talking about it, Agnico Eagle and Yamana,
and,
right?
I think I don't have it in front of me, but I think Pan American's involved too. It's mostly Pan American.
Yeah, Pan American. I think this is great. I want the sharks out of the water, right? So if Yamana gets taken out, that's one less shark that can basically eat me. Let's say that I'm an AIA, right? Or I'm a Go Gold. I don't want to get eaten by the shark. So the fewer the sharks in the water, the better. I want these sharks out, This is a really good deal. These are quality properties. Yamana has quality properties. So Agnico, it makes Agnico stronger, makes Pan American stronger. It's a great deal for both of those companies. I'm hoping that Newcrest gets taken out. That's another shark out of the water. Kirkland Lake got taken out of the water. That's 3 sharks, right? If there's only 10 sharks hunting, that's, they can only eat so much, right? They can only do so many deals in a year. Each deal takes a lot of time and effort. So it's going to, the fewer sharks there are, the less M&A there's going to be. It's going to slow everything down. I like it when these big companies take each other out. I think that's fabulous. Again, to answer your question, I think this is really positive for Agnico and Pan American. They're getting some really good mines.
How about for Yamana? That's the one I hold the most of.
You have to decide. So Yamana, Yamana had more upside than Agnico and Pan American. So you're going to get shares in both of those companies. So you basically just have to decide: do you want to own those? I would want to own Pan American for sure. I would be tempted to basically sell the Agnico shares and roll them into Pan American, because Pan American has better upside than Agnico. But then if you want income, then you'd roll it over into Agnico, because it's going to have a better dividend. They're like 3%. Pan American's like 1%. I think that Pan American and Yamana are very similar as far as return goes. I think they're very similar. So if you're rolling your money from Yamana to Pan American, that's, to me, sounds like that's a really good trade. You're basically not losing anything. As a matter of fact, Pan American should outperform what Yamana would have performed, right? Because Pan American has those 2 huge silver projects that could get built. You aware of that?
Yeah, so it's something interesting to be involved in. So that's pretty much my question. Yeah. Thanks for answering it. Anyone else have something else they'd like to jump into? Jabroni, I see him jumping in. Eric?
We've got another written question here on AUMN. This is Golden Minerals Company. He says, I'd like to hear Don speak on this. It's a gold and silver producer at 25 cents, flagship 10-year mine, expecting to go into production 2023.
Yep, this one's going to be a real quick answer. If you don't own it, you want to wait until they get Velardina up and running. And I don't think they're going to get Velardina up and running until, they wanted to do it last year, but silver prices aren't high enough. I think they need $27-8 silver before they start Velardina, because they got to make sure it works. They're not going to restart that mine at $25 silver, because then silver goes down to 20 and they're like behind the 8 ball. Velardina is a really solid property. I like golden minerals, but the key here is Velardina. Then they have another mine that I think Barrick is a JV for that they're probably going to get back, which is very valuable as well. So that's and that just gives you more upside. But Velardina alone probably gives you a 5-bagger. But the key is, I said it was going to be a short answer, and I keep talking. Velardina, I think we need to wait and see. You could possibly buy it, maybe a month before it goes into production, something like that. If you're confident that you can call them up and talk to them and ask what the cost, what they think the AISC is going to be. They'll probably answer your questions. But until Velardina is in production, I think this is a watch stock. If you do own it, you can just cross your fingers. I think it's going to work out. I own it. I'm optimistic that once gold and silver break out here, once we get silver above $30, I think Velardina is going to work pretty well. It's 1 second here before I wrap up the answer. I'm gonna take a quick look at golden minerals. Where are you? Golden. Oh, there it is. I'm gonna take a quick look at their numbers. Okay, so they have a market cap of 44 million, which is pretty darn low for what Velardina. So at 3 million ounces a year, which is Velardina, they actually print as almost a 20-bagger.
Nah, Patel.
Whatever that was. So they got some golden minerals has some serious leverage if they can get Velardina into production. 3 million ounce production, they could have 140 million in free cash flow at $100 silver if silver get that high. But even at $50 silver, they'd have 50 million in free cash flow, and their current market cap is less than that. So that usually points to about a 5-bagger. Whenever your free cash flow is higher than your market cap, you're looking at a 5-bagger. So, they definitely, it's definitely an interesting stock, but management hasn't been the greatest executor, and I think so. Velardina has 45 million ounces. That's what I wanted to look. They have 45 million ounces of silver at 300 grams per ton, so they can mine 3 million ounces a year for 10 years. And then El Cuvar has a 30%. They have a JV with Barrick on their El Cuvar, which has 50 million ounces. So it's a little bigger than Velardina, and they might get that back. Because I don't think Barrick is going to build a 50 million ounce silver project, and so they get that back. And then the one thing that's really interesting about this whole company is when they acquired Velardina, they acquired it in 2011, and the company that they bought out was called ECU Silver. At the time, ECU Silver had they said that Velardina had 340 million ounces of silver equivalent, and today they're saying 45. Let me repeat that: 340. It was in their annual report in 2012. So there's some serious silver on Velardina, but they've never drilled it. So that's a very interesting story there, because they're saying Velardina is 45. I think it has a heck of a lot more.
Well, I can tell you as a little extra tidbit, from a technical perspective, this is a pretty easy chart to read. If we were to continue to get a sell-off, you're looking at a pretty clear level there at about 20 cents flat. And it has broken below 20 cents twice in its history, fell to about 13, at which point it had pretty immediate and substantial rebounds. So if it sells off and you're bullish on it and you want to add, maybe look around 20 cents and hopefully catch it somewhere around there.
That's a good suggestion.
Eric, what's up, brother? How you doing?
A little late to the party. Thanks for letting me in here. So, Don, my question is to you. I don't know what's been talked about since I came late to the call, but I got interested in the Newfoundland area here recently as the hype has gone away and everything in the gold space has been pretty well bombed out over the last few months. What do you think about some of the explorers that are out there around Newfound gold?
Well, the one that's exciting to me is Newfound gold. I think it's going to be north of 10 million ounces, and we don't know how big it's going to be, but it's going to be a big mine. That's really the only one currently that I'm excited about. I do like Marathon a lot. I think Marathon's, it's going to be the first mid-tier producer in Newfoundland. Signal maybe could end up being something. Maritime, that one's a kind of a high-risk stock. And then you got Sokoman. That's interesting. But most of these early explorers, I'm not, I think nothing super exciting. I'm missing Labrador. So Labrador, that's another one that has potential, but I'm not super excited about it. I think that Newfound gold is the one, if you're gonna be a true believer in that area, I think that's the one that you want to hold, because in theory, if they keep finding more gold, it could be a 20 million ounce deposit. If it's 20 million, then I think that gold in the ground at $2,500 gold. So if we go to $2,500 gold and it does not retrace, we go to 2,500, it stays above 2,500, and we go 26, 2750, we're above 2,500. Gold in the ground is going to be worth about $100, should be worth at least $100. And so, if they do find 20 million ounces, that's a $2 billion valuation. So, that's a long shot, right? They might not find it, but if they find 15 million ounces, it's 1.5 billion. So they're currently valued right around 200, I think. So there's a ton of upside still in Newfound gold. The other thing about Newfound gold is it's sold off quite a bit. So you actually are getting, a bit of a discount here off of its all-time high. So it's trading, ouch, it's at 660. I didn't realize it was at 660. Its current valuation is 660 million. So I'm thinking it's worth 1.5. That's only a one bagger. So maybe this baby's too pricey. Even if it got to 20 million, it's only a two bagger.
Do you think Newfound gold could start to turn into a gorilla, eating up all the juniors around him?
Yeah, absolutely. It could. If the problem though, they have their hands full already. They want to drill. It depends on how many targets they're going to drill, but it looks like they want to drill like a 50,000 to 100,000 meters a year. So, that property the Queensway property is 350,000 acres. So they got their hands full there. So even if they acquire these other ones, they don't have time. They got 14 drills turning, 14. So yeah, they got their hands full. Wow, 660. That's pricey. I thought it was cheaper. So yeah, it's an exciting story, but it's I don't know if we're going to get a three bagger out of it. Maybe, probably not though. So yeah, Newfoundland. I'm with you. Some of these early juniors, it's hard to know if they're going to do well. It's just such a lottery pick. It's so hard to make money on those. You just don't know which ones are going to pay off. I personally like to buy drill stories that are basically working. They're growing in size, and basically that it's going to get bigger and bigger and bigger.
So do you like is your strategy kind of like, okay, this junior explorer had a big first hole, or not hole, but their first big hole, right? They might have been drilling for a couple of years and they get the first one. Right. Is that what usually piques your interest and says, oh, like Sokoman had 41 grams per ton over 10 meters. Is that what gets your interest to say, okay, now I'm going to look at this one?
Yeah, absolutely. I call those discovery holes. And unless a company has what I call an excellent discovery hole, it's kind of a waste of time. They haven't found a big mine yet. A guy did a research and he wrote it up a couple of years ago. And basically what he found is that nearly every big mine that's like 2 million ounces or larger has a significant discovery hole. And the bigger the discovery hole, the bigger the mine. And so the takeaway is that if a company doesn't have a discovery hole, then they don't have a big mine. And if they don't have a big mine, you're not making any money. So yeah, you got to wait for the discovery hole before you even jump in. Now that I call them the discovery holes, gram meter holes. So the one you just gave me is 410 gram meters, 41 by 10. So that is, that's an excellent discovery hole. Absolutely. So you want it to be at least north of 200. And ideally you want to have a few follow-up holes. So yeah, Sockman might be onto something, and then Labrador as well. But yeah, that's what I look for. I look for significant discovery holes, and then a few follow-up holes, and then the geology, the size of the property, and then how many drill targets they have, and then how excited like the geologists are. I mean, sometimes the geology could have the expectations of a big mine, and then you hit the hole, and once you hit the hole, then you're kind of off to the races. Kind of a good example is like Lion 1. They expected, based on the geology, they expected to find some high grade, high width holes at depth, and sure enough, they've had like 2 or 3 of them. So they're building an open pit at surface, but their underground mine keeps getting bigger and bigger. So that's the kind of drill story that I really like, because I just know they're going to find more and more. K92, it's a pricey one. That's another one. They said it's going to take them 10 years to drill out that thing. They just keep finding more and more and more gold. So when you're finding gold, especially when you're a producer like K92 and Line 1 are both going to be producers. K92 is a producer. Line 1 is going to be one. So if you find gold at $25 an ounce and then you turn it into production, it's worth $250 or more. Versus if you're an exploration company, you find it at 25, you might only sell it at 50 or 100. So you get this huge leverage if you're a developer or producer. So I prefer drill stories that are combination exploration. That's why some of these companies, if they get into production, they have tons of exploration potential, but they haven't drilled these things out because they don't want to waste money. But they know the gold's there. They know it's there. They just haven't drilled it yet. There's a ton of stories that way. So just pure exploration, those don't get me as excited because, they're only going to sell for maybe $100 an ounce. And so you're not going to get those, those 5-baggers. So a lot of people roll the dice on these early exploration plays. And sometimes they get lucky, like at Snowline, that thing you get in with a market cap of 30 million and then suddenly it's up to 200 million really quick. But those are, you don't see too many of those. You got to get into those really early. You want to really get them before, like 50 million or less. You hit a few holes and you get in, they hit it. It's tough. If you, the people that are just following these, pure exploration plays, you're either late to the game, like a Newfound Gold. Now I see it's at 660. It's way too late to the game to get in. And so you're either late to the game or you're early, and you get in early, and then you get diluted into the ground. You end up losing money. So exploration it's tough. People love it because you can get a 5-bagger in 3 months, and then it can keep running. So people love they love to hit the lottery per se. But I prefer kind of the optionality development. Like, for instance, Galantis. I'll give you another example. I just think the risk reward is so much better. So I'll give you a few examples of what I mean by development drill stories. Galantis is in Ireland, and they have a really large property, what they think is just loaded with veins. So they've only found like 5 veins so far. So they're only producing like 10,000 ounces this year. but this thing's going to grow over like 5 years. It's going to grow into, 50, 70, 80,000 ounce production, but they're just going to steadily find gold. And then, that's one example. The other one is like Cabral. Cabral's trying to get into production, but they know that they have like 3 million ounces plus on the property. So once they get into production, then they can start drilling it out and it can start growing. So I like and then you have other plays that are what I call kind of optionality developer that are kind of more higher risk. In other words, like Discovery, they're like loaded. Discovery's like 1 billion ounces of silver in the ground. So it's optionality, but they're also development. So you got optionality development. So I like those kind of combinations better than just the pure exploration. That's why I say pure exploration should only do like 5% of your portfolio, because the risk reward just is terrible.
I appreciate the info there.
Thanks for the question.
All right, Don, I got one for you. And before I do, of course, anyone else is welcome to come up. Just raise your hand, request to speak, or you can write your message in the chat there. I'd like to ask you about Osisko development. It dropped 18% today. Had a big gap down. It looks like they had a $45 million bought deal financing.
Wow. 18%. So I really liked Osisko development. I don't own it. I forget how. So the project that they own, let me look at this up. I owned it at one time, but I think they stole it from me, like with an old cash deal or something. That was when Osisko Royalties came in and took out my company and basically just pushed me to the side. So that's how Osisko Development got created. They were a spin out of Osisko Royalties for their Caribou project, which I really liked. The Caribou project, 5 million ounce high grade underground mine. So they want to start construction on it this year and next year. So it's going to produce 250,000 ounces a year. And the AISC is projected to be around $1,000. So it's a very economic project. So I always liked that. And I actually owned the company that they took out. I forget. I don't have it in my notes. So I'm surprised I don't have it here. But yeah, so at one point, the Caribou project, I did own the company that owned it, and then they got taken out in a cash deal, and I got pushed to the side, very disappointed. And I've never gotten back into it, but now they've added on 2 additional mines. So the first additional mine is down in Mexico. It's small open pit, 1 million ounces. They'll probably end up selling it. So it's just. Who knows? We'll see what happens. They want to produce 50,000 ounces a year. I just don't think it has enough bang for the buck for them, but we'll see. And then they just acquired the Trixie mine in Utah, which is really interesting. I thought they overpaid for it, but they must think they paid over $100 million. I forget exactly what the exact prices were, but I remember it was over $100 million. Oh, they paid $170 million. So they paid $170 million for this Trixie mine in Utah. So $170 million. I mean, that's got to be at least 2 million ounces. I mean, at least, if you're going to pay $170 million, because look at all the projects that are available to companies that are available. I'll give you one example. Vista Gold in Australia. Their market cap is like 80 million, I think, and they have 5 million ounces or more, 8 million ounces. And their market cap's 80. So they could have given them 100. They could have got, 5 million ounce. I forget Vista. Let me go and look and see how big Vista is. I'm just saying that they paid 170 million for this thing, and the maiden was only 1 million ounces. So they must think there's a ton of gold there. So the Mount Todd project in Australia that Vista Gold owns is 8 million ounces, and the market cap is 71 million. So they could have bought that for 170 million. I think Vista probably would have taken 100%. They probably would have. Well, they could have probably got it for 200 million easy, right? So that's how cheap some of these projects are. But they decided, no, we don't want that project. We want this one. And we're going to pay 170 million for a maiden of 1 million ounces. So, how big is it? How big is this Trixie? We don't know. But this is where it gets really interesting. You're getting the Trixie mine and the San Antonio mine for free. I always say this because the Caribou project is worth $1.5 billion all day long. It's basically a 5 million ounce. The Caribou project's in British Columbia. It's 5 million ounces, 250,000 ounce annual production in British Columbia. So, I mean, that thing's worth a lot of money, just that mine alone, right? So you're pretty much getting these other mines for free. So that makes this project very interesting. And the other thing I like about it is Osisko Gold Royalty owns 44%, so nobody's going to take them out. And then the company that they bought the Trixie mine from, they gave them shares. They have 16%. So there's only 50% of the shares are not trading. So they only have 102 million shares out. They have 76 million shares outstanding, and only 38 million shares are basically trading. So it's really tightly held. So I'm surprised it went down 18% today. But it's not super cheap. I thought it would be cheaper. It's not 198.10. Yeah. It's not. I'm watching it. I don't own it. It's right now. It's not cheap enough for me to buy it. But if we get a sell off and this thing drops under 400 million, I might throw this thing on my buy list, because I like the Caribou mine a lot, and the Trixie mine. They love the geology. They must think this thing is, pay $170 million for basically based on geology, because all it has is 1 million. I mean, they knew it had 1 million ounces, but they got to drill to find more. It has, on the Trixie property in Utah, it has 23 past producing mines on 14,000 acres. So that's a lot of mines. That's a lot of acres. So they got a lot of places to drill. Their target, they think that they can get this thing up to 100,000 ounces a year. So if they do that, if you combine Caribou and Trixie, that's 350,000 ounces, excuse me. And then if they did build San Antonio, that would take them to 400,000 ounces potentially. So that would be about $3 to $4 billion valuation at $2,500 gold. So it's definitely an interesting company, and I think the management's pretty solid. So I gotta give it a thumbs up. I hope it drops to 400 million. I'd love to get in at 400 million.
Right on. Appreciate the answer. We have another written question about Liberty Gold. You kind of broke my heart a little bit on this one about 3 months ago. Have your feelings changed? What do you think about Liberty Gold here in February 2023?
Well, since we had that conversation, they actually came out with an increase in the size of the property, in their resources. So it's actually starting to turn into an optionality play. My problem with it is they're just not giving enough guidance other than drilling. Okay, so here was the comment. This is interesting. This was 3 days ago. This is on February 7th. I'm reading the quote from the company. It says, "At this point, with data in hand from the resource update, both within and outside of the current resource pit, we believe that geological potential across our 2 Great Mason properties could extend to at least 7 million ounces." That's quite a statement. That is.
Isn't their current, or aren't they looking at 1 million where they are right now? That's sevenfold, right?
I have them at 3 million right now. So it's more than double their current resources. So that basically turns them into an optionality play, because they're currently valued at $140 million. So if you take 7 million ounces, 100, that takes him minimum value of $700 million if they sold the company. So it's basically about a 3-bagger right there. So yeah, it definitely improved, but I sure would like to see some guidance from these guys other than just drill. They seem to be very happy. The other thing that's really interesting here is the CEO is Mark O'Day, and he just had a big blunder at Pure Gold, right? He was the CEO of Pure Gold as well, I think. He might have been chairman. I know he was on the board. I thought he was a CEO. I could be wrong. But basically, O'Day wants this to be a winner. So, but simultaneously, he's probably a little nervous about building the mine after what happened at Pure Gold. So I don't know. It's as an optionality play. It looks decent. I mean, if you're getting 7 million ounces of gold for $140 million, that's not a bad deal. If it does turn into 7 million ounces, and if it does turn into 7 million ounces, I mean, which one of these is going to get huge? One of these has got to get huge, right? Because I have Gold Strike at 1.2 million, and then where's the other one? Black Pine, I have Black Pine at 2 million. So one of those has to get really big. Which one?
Right.
Yeah, I mean, this company could do really, really well if they just say, okay, we're going to build, this mine is the most economic mine. We're going to build it first. The problem is that both mines are low grade. But if gold prices go up, if you start building it today and then the mine prices go up, and then once you put it into production, gold's over 2,000, everything. I mean, you could gamble. I mean, it's not as if I think the IRR is still economic, at $1,500 gold, maybe 16. It's not like it's super uneconomic, but it's not, it's not. Ideally, you want it to be economic at like $1,400 gold. 1,300, but I think it's probably economic at 15, 16.
We've talked a lot about M&A and a couple of particular companies. How important do you think that is for the sector if we start seeing it? Is that an important thing to look for? And if we start seeing it, is that a signal of things to come? I mean, in your experience in the sector,
yeah.
What does that really mean? Is that overrated or?
No. So in 2020, we had this big move in prices, and M&A started kicking into gear really quickly. And then 2021, they were doing 3 deals a month. I was seeing 3 deals a month back in 2020, 2021, and then they just stopped. Then we started getting 1 deal a month in 2022. Everything kind of just froze last year on the M&A deals. But you can expect the M&As to go 3, 4, and 5 deals. Once we get to $2,000 gold, you can expect M&A to go 3, 4, and 5 deals a month. It's gonna go nuts. It's absolutely going to go nuts because everybody's going to basically be positioning themselves for higher gold prices. It's kind of a now or later. That's how the industry works. During these bull markets, you see a lot of M&A because people are. They realize it's either now or never, because if you don't do the deal now and then gold goes to 2,500, then you can't afford it and you can't do the deal. It's too pricey. And, so the M&A is really going to pick up once you get above $2,000 gold and above $30 silver. Especially, I think in the silver space, because there's so few silver projects, I think you're going to see a lot of deals in the silver space as people get desperate for acquiring a silver mine, or desperate for merging, or desperate for acquiring. Yeah, there's just not that many silver projects, so I think we're going to see a lot of desperation. So silver in the ground, right now is valued around 50 cents to $1 an ounce, maybe less because we're at $22 silver. but I think you'd be foolish to sell for less than 50 cents an ounce. But let's say 50 to $1. I think we're going to see, silver be worth $2 and $3 an ounce once we get to 50 because of the desperation. But $3 an ounce silver is very, very valuable. I mean, if you price out some of these companies, that have, 50,000 ounces or more, at $3 silver, it's pretty significant. They're worth the value. They're undervalued. So, the value of the gold in the ground. So I think, silver is going to go, after we get above $30, it's going to go above $1, and then it's going to steadily go up, 1, 2, 3. And it depends on the grade, of course, and it depends on the location. If you get in the upper range, so that's kind of the range, $1 to $3, and then the better economics, the better locations, you're at the upper range, and then gold is going to be $50 to $200. It'll be interesting if we see any projects, any exploration projects, because whenever you get an M&A deal that's kind of above the range, that resets everything. It raises the values of all the companies. It raises everybody. So if somebody does a deal and they pay like $250 for an ounce in the ground, let's say, so we have, a 1 million ounce gold project or 2 million ounces, and, somebody pays $500 million for it. So that's going to raise everybody's value up. So I remember back in, I forget the year it was. Company got taken out for, it was a gold project in Mexico, 2 million ounces, and they got taken out for $200 an ounce, $400 million. And I was like, wow, that they paid a lot for that mine. And that resets the whole industry. And so that's what we can look forward to. So the M&A deals literally raise the valuations of everybody. Suddenly your company is worth more. So a perfect example is like Tudor Gold. So Tudor Gold's got 27 million ounces of gold right now. That thing is going to get bigger. I think it's going to get, at least 35 million ounces, probably 40 million ounces. So it's currently probably I forget the value. Today it's valued at $10 an ounce. So it could easily get valued, like all these M&A deals start raising the price of the value of gold in the ground. Suddenly Tudor Gold's worth a fortune, right? I think Tudor Gold's probably going to be worth $100 an ounce when this thing's all said and done. So that's one of those optionality plays that's just ridiculously cheap that everybody's kind of ignoring right now.
So, Don, in the silver space, when you're talking about potential $2, $3 silver,
yeah,
I would assume Discovery Silver would be one of the plays you would want to do. What are the other couple that would be in that mix?
Right. So Discovery is actually a development story. So when I was saying 1, 2, and 3, I was actually talking about exploration companies, they just flat out want to sell their project. Discovery, they wouldn't sell for less than $5 because when they produce, they're going to get free cash flow. So when you're going to get the free cash flow, your silver in the ground's worth more. But so that's why if I was Discovery, there's no way I would sell for less than $5. So it's like they have 1 billion ounces, but they only have like 500 million of kind of phase one economic silver. So they're worth. I think Discovery's worth like $2.5 billion. I wouldn't, if somebody wanted to buy me, that would be my selling price. So if I'm a developer, I'm above those levels.
Well, that's quite a deal with a company with a market cap just over like 350 million.
It is, but it's going to take them a while to get into production. Now, again, I'm priced that 2.5 billion. That's when silver's above 50, right? I'm not for sell today. I'm looking at the future. So yeah, today, they probably are not going to. No one's going to pay 2.5 billion for that company. But that's what I kind of value them at. When I look, when I look at that company, how much do I think it's worth? That's what I think it's worth. I think they're worth 2.5. If I own the company, that's, if I'm on the board, it's like, no, we're not, there's no way we're not for sale for anything less than that. Another example is like Skeena if you look at Skeena, what's that company worth? So they're building the mine today. They're not going to be in production until now. They're not cheap, they're not really super cheap. But how much is their gold in the ground worth? So I think it's since it's a development story, if it was just a pure exploration story, it would only be worth like $100 an ounce. But as a developer, it's worth, at least $300 an ounce. So I basically, I give more value to a company that can turn that gold in the ground into free cash flow at higher gold prices. But I didn't answer your question. You said something about Discovery and other silver mines.
Yeah, like, do you have another top two that have kind of leverage, like you're talking about with Discovery?
Oh, yeah. Other optionality plays that basically $10 an ounce, like Tudor. Tudor's a really good optionality play. Discovery is an optionality play on combo, because they're also building it. It's basically the value of the company is worth more than they are because of all the optionality. I like that story as well. So anything that's pretty big. So yeah, let me go to my Substack. I think I have a list of optionality plays that I like, and I can bring that up and mention a few of them. Okay, I'm here. Let me find my list. There it is. Best optionality plays. Okay, Southern Silver would definitely be one of the ones at the top of my list. If you look at Southern Silver, they have like 200 million ounces and their valuation is like less than 100 million. So they're trading for like less than 50 cents an ounce in the ground. Another one that I like as optionality is Golden Tag. The other thing, Golden Tag just made a deal. So they're now, you're getting that combo that I was talking about. Golden Tag is actually going to be a producer. So they're buying on a silver mine from First Majestic. And so it has a low capex, has a low restart. It's like a 12-month restart. The project hasn't closed yet, but suddenly now Golden Tag looks, it's like that combination, like Discovery. Another one with a combination is Chesapeake Gold. So Chesapeake Gold has 18 million ounces of gold, 500 million ounces of silver. So I like that one as an optionality. I think those are kind of like my top four, I believe, as far as, in Tudor, when you're just getting. Another one that I found that I really like as optionality is Moneta. So Moneta's got 12 million ounces of gold, and their valuation is like under 150 million. So Moneta and Tudor, these kind of lots of gold in the ground that is going to get revalued higher, basically. Really interesting optionality stories. A couple others that I like that are not quite as interesting, but definitely interesting. One is El Oro. So El Oro, they haven't done their maiden resource yet. It's more of a tin mine than it is a silver mine. It reminds me a little bit of Santa Cruz. So Santa Cruz and El Oro, both of those mines are like base metals mines, but they have like 25-30%. Santa Cruz maybe has a little more revenue from silver. So El Oro could be a billion plus silver equivalent. So El Oro is interesting. And then I think that the last one that I'll mention is OMAI Gold. OMAI is really under the radar here. When they started drilling it, their target was they started drilling this mine. It's in Guyana. The symbol is OMG. Oh my God, right? And the first time I looked at it, I said, oh my God. So they started drilling it in 2021, which is only 2 years ago. And their target was 4 million ounces. And they're already to 3.7, which is amazing. They didn't think that they would get there in 2 years. And so after they drill this year, this thing's going to be well over 4 million ounces, and their target now is north of 5 million. So basically, its market cap is like $30 million. Nobody knows. This thing's totally under the radar. So as an optionality play, your OMAI is, I think it's going to be basically a 5 million ounce mine. So 5 million ounces at $100 is $500 million, and their market cap is 30 million. Do the math.
Yeah, that's a good one.
Yeah, it's crazy cheap. Oh, okay. So now, since I said crazy cheap, there's actually another one that's probably cheaper than it's cheaper than every stock I mentioned for optionality. And that is the cheapest stock. And I can't figure out why it's so cheap, but it's currently, there's some stocks that are just silly cheap, but this is one of them. And it's Hummingbird Resources. We can definitely think in terms of optionality on Hummingbird. So let me throw the numbers at you on Hummingbird. This one is just so weird; it just makes no sense. But I think you need to buy it in London because it's in the pink sheets on OTC. Okay, here's the numbers, and it's going to blow your mind. It blows mine. Their market cap is $35 million. $35 million. Now, they do have a lot of debt, $100 million in debt, but they have $25 million in cash. And their last quarter, their AISC was like $1,300. So they're generating $23 million in free cash flow. So they don't have high cost. They're producing currently 90,000 ounces in moly. It's almost as if somebody expects the moly mine to shut down. The valuation makes no sense. Okay, so they're currently producing 90,000 in moly at their mine called Llano Folha. It's a 1.8 million ounce mine at open pit at 2.5 grams. So in other words, it's a high grade open pit, and they're mining 60,000, and their break even is 1,500 or less. So they are generating free cash flow. They're not losing money, right? Okay, so that's mine number one. So that mine alone, 90,000 ounce producer, is worth more than 35,000. Their market cap at 35 million. Okay, now they have two more mines. The second mine is called Kouroussa. They have these strange names. Kouroussa. It's in Guinea, which is in West Africa. And they got it for like this bargain price. They paid like 25 million in cash in shares. Well, it's under construction. It's almost done. It's almost built. And they didn't have to add a ton of debt to it. They borrowed $25 million. Well, that mine is going to produce 100,000 ounces in Q2 of this year. So they're going to be, in June, once we get to Q2, they're going to be a 190,000 ounce producer. And their current market cap, again, $35 million. Well, it gets better. I'm not done yet. The next one is they have a 50-50 JV deal with a project in Liberia called Dugby. And here's the kicker. It's a 4 million ounce project at 1.5 grams open pit. So it's basically economic. The construction decision is due this year, so it's highly advanced. And it could go into production in 2025, which would give them another 100,000 ounces. So they're basically going to be a 290,000 ounce producer, and their market cap is $35 million. So if we look at their resources, we're talking about optionality. I only have the resources at 5 million ounces. So it's not super, they're not, tons of resources, but 5 million ounces is still significant, right? So, and I have their break-even costs at $1,500, but
Don, does that include like any kind of crazy taxes from these countries for, windfall taxes or anything like that?
No, it's not like Ecuador where we have a tax problem in Liberia. So they're in Liberia and Mali and Guinea. Those three countries, they're just West Africa. And it's so crazy. It's like everybody's been selling the heck out of this thing. I mean, if you look at the chart, it's just going down, 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 down. It just keeps going down. But as it goes down, it just keeps getting more and more valuable. They're trading at 1x free cash flow right now. It's like, what's going on with this company? I can't figure it out. It's like,
do they have a bad capital structure, like a toxic floating convertible?
I don't know if that 100 million. You're right. It's like something's fishy here. So they owe $100 million, but they got 25 million cash, and they're generating $2 million in free cash flow every month, so they can roll over that debt. But on top of that, they own 50% of Dugby, so they could sell if they ever run into problems, they can sell that. It's a 4 million ounce project and it's advanced. So Dugby's worth, at least 25 million, easy, and it's probably worth 50 million for their half. So they could always sell Dugby if they got into a scrape. So I'm trying to figure out the problem. And if Yanophilia goes offline, then they have the new mine that's going to come online in June, and that mine's worth, $300 million plus. So it's hard to see how you lose money with this thing. They're buying it at this low valuation. Now, somebody send me a text, send me a DM me on Twitter or send me an email. You can always find me. If you just go to my website and just do contact us, I'm going to get that email. So it's easy to contact me. And so somebody can do some research on this. Now, here's the bad thing. When I send emails to this company, they won't reply. That's a bad sign. That's a red flag. I've sent them 2 emails. They haven't replied. So,
Don, do you have any opinion on G Mining or Aeris?
Yeah, I do. I have opinions on everybody, right? So G Mining, the problem with G Mining is that they paid it. They basically had a high capex for this project. So they have a lot of debt, and they don't have a pipeline. So I don't have any FOMO for it because it's not super cheap, and there's no pipelines. But they're mine builders. So if you buy G Mining, you're just buying for growth. You're just going to wait for them to basically grow. Now, if they bought Cabral, Cabral's right next door to them. If they bought Cabral for growth, that would be fabulous because Cabral's got 10 bagger plus upside. So if they bought Cabral and they paid 100% premium, they'd still be getting a super deal. Cabral is like they're pennies on the dollar. I like Cabral a lot. Yeah, G Mining acquires Cabral, or if they acquire, maybe some projects from Gold Mining Inc. Gold Mining Inc. has a bunch of projects. G Mining is ready to build some mines. They know how to build mines. I like G Mining from a growth standpoint because I think they're going to buy some mines and build them, but I don't like their current valuation. I like the management team. I think they paid the capex was too much, a lot of debt. So, but overall, I think G Mining is, a positive story. I think it's probably going to work. What's the second? What was the other mine? Yeah, didn't you mention 2?
Aeris.
Yes. I'm a big fan of Aeris. So Aeris is another one that has 4 projects. They're building 3. They're just, as a long-term play, they look really, really good. I do own it. I've owned it for a long time, since Grand Columbia days. So their mine in Colombia, their underground mine, plus in Colombia, I don't think underground mines are going to be a problem. I think open pit mines are going to be a problem. So all of their mines, they're building an underground mine in Colombia right now, which is going to be their second mine. How come I can't think of it? I should know the name of it. And then they're going to build, after they build that mine, they're going to build a mine in Guyana that's Toraupu. It's a huge mine, 12 million ounce open pit mine. And then they have another one in Colombia. They're going to come back, another underground mine to build. So they got a huge pipeline. Marmato. So Marmato is their second mine. It's going to take them a while, though, I have the full production isn't scheduled until 2026. That's kind of ugly. So this is a real long-term story, but it's really cheap over the long term. So this is a company that could I mean, you're looking at, a major in the making after they build all these mines out. But it's going to take them a while. I mean, they have 25 million ounces of gold now. So I love their pipeline. I like their management team. I like their free cash flow. But this isn't a company you're going to get rich with in the near term. It's like, this is a 3 to 5 year investment. It's a long-term deal to really, get huge returns on. But yeah, I like it a lot as a long-term play. So we'll see how they execute.
So I see we have the Silver Chartist. If you're welcome to join in if you'd like to, or Jabroni, jump in if you want.
Yep. If anybody has anything, it's a good time to do it. We'll probably call it here fairly shortly. Lady Liberty and I have a date tomorrow out on the lake, so we got to get to bed before too long. But I do have one for you while anybody else decides to come up. Don, I noticed a few days ago you put out an update, and that update included Northern Dynasty. And it looks like you're now considering this a potential lottery ticket that may evolve if we get a new administration. Can you kind of elaborate on that?
Yeah, absolutely. So when I say new administration, like Northern Dynasty is talking about Pebble, right? Everybody knows about the Pebble project in Alaska. So that project is not going to get permitted under Biden. It's not happening. But the company is still well funded, so it's not like the company is going to walk away from this. So they're going to stick around until 2024. They're waiting to see, who wins the presidency in 2024. If a Republican wins, and that Republican basically, goes to bat for Pebble, I think it could get permitted. Absolutely. So it's a lottery pick, but I wouldn't buy it now. I would wait, and then November, the first Tuesday in November in 2024, the first Wednesday, if the Republicans win, I'd buy it as a lottery ticket. Absolutely. The worst case, it's going to double. I guarantee you that. But it'll probably, you might have to do it, like September of 2024 before the election. Because a lot of people are going to think like me that if the Republicans win, this mine could easily get built. So September, October, November in 2024, it's a long ways from now, right? That period, that's when Northern Dynasty is probably, it's probably going to be trending up. Put it that way. It's going to be an interesting stock to watch in the summer of 2024 as people play that optionality, right? Because if it gets built, it's a 10-bagger if it gets built.
Yeah, I would say that you'd have to play it 4 to 5 months in advance. And the reason why is I saw this in the solar industry before Biden became president. And okay. I think the company's called Enphase, if I remember right. Okay. Stock was at $1, launched to over 100. And I think it went from like maybe $1 to about 20 or $30 before the election. I'm just trying to go off memory, but staggering moves, months before this happened.
Yeah. That's kind of what I was thinking, that you'd have to go back to at least September before it's going to start moving. Like sometimes in the summer of 24, it's going to start trending up. Because the reason why it's going to start trending up is because the Republican is definitely going to have a chance, right? It's not as if they're not going to have a chance. We're not going to know who the president's going to be, right? In the summer of 2024, we're going to have no clue. It's going to be up in the air, right? So yeah, it's definitely, you're right. 4, 5, 6 months out, you might want to take a flyer on it.
Let me play devil's advocate here because I happen to agree with you. This is a play I've been looking at for a while for the same reasons, and I own it. It's a lottery play. It's not too much, but I would look to add to it for the same reasons you've outlined. But to play devil's advocate, I mean, Trump tried to get this push through, and I think it was the Army Corps of Engineers or something along those lines that actually denied him. What do you think that the next administration could do that Trump couldn't? Or is it going to be more about circumstances that we're going to need the resource?
I think it's going to be more about jobs. I think that there's going to be so many jobs, and I think Alaska is going to be, the governor, is going to be pushing for it. So last time, again, there's no guarantee. That's why I say it's a lottery pick. There's no guarantee that even if a Republican wins, that they're going to get a permit. I'm just saying that the odds of a permit definitely make it lottery pick type stuff. I would not own it today as a lottery pick. It's like no way. But if a Republican wins in 2024, it might be a pretty, not a terrible lottery pick. So we'll have to wait and see. But yeah, Trump, it didn't get permitted under Trump. Might not get permitted in the future, but I think that. We're talking about 5,000 jobs, something like that. It's a lot. They need a lot of workers. Maybe that's too many. Maybe it's 2,000 jobs, but it's still a lot of jobs. So I think it's the reason why it will get permitted under Republican is just for the governor is going to basically put pressure and the administration. Let's get this done. So we'll see.
What about Arcana as a lotto?
Arcana's bankrupt. They're bankrupt. They're in receivership.
No chance of any like a Eric Sprott.
No, it's owned by the bank. Arcana's owned by the bank. It's over. There's somebody right now. Somebody's looking at it. So I have my fingers crossed that they get it. Somebody's talking to the bankers right now, trying to buy it from them. So fingers crossed that they get it, because if that company gets it, it's going to help them a lot. It's going to be an exciting acquisition for them. So yeah, Arcana, they're toast.
All right, we'll make this last call for any more questions for Don as everyone decides whether or not they have anything they want to chime in. As is the habit, Don, I always like to spend the last couple of minutes and get a smidge political on you and kind of put you on the spot. So what is your base case for the next round of elections? I know we got a little bit to go, but if you had to place your bet today, what do you see happening?
I actually wrote a book on this topic. It's called America's Political Cold War. I can't even think of the time of it. I came out about 6 months ago. So I wrote a whole book on this topic, actually. So yeah, let's do a little politics here for this last answer. I'm gonna go and I'm gonna look up the title because I can't think of it. America's Political Cold Wars. America's Political Cold War. I got the title right, but the subtitle is Conservatives versus Liberals: Why Neither Side Can Win. So we've actually reached a point where our political system is broken and it's not going to get fixed. So it doesn't matter who wins, because we've gotten to the point where now it's all or nothing. And whenever you try to legislate from that standpoint, you just get a mess. You're not going to get answers, right? So it's either, you get, the Republicans control, both houses and the presidency and the executive branch, or the other way around. One party has to control everything in order to make any change, because they will not work together. Just total intransigence. A perfect example. This is a great example. Is that they voted in the House this week to drop the rule that if you're not an American citizen, but you want to travel to America, you have to be vaccinated. And America is like one of the last countries in the world that requires this. I just traveled to Canada last week. They don't require it, But if let's say that since March of 2020, if you're a non-citizen and you have family in the U.S. and your family refuses to fly, right? You haven't been able to come and visit you haven't been able to visit your family. But the thing that's so nasty about this is that the vote was nearly every Democrat voted to continue the requirements that foreigners be vaccinated, mandatory to come to America. Now, the only reason why they did it is because of their intransigence of not wanting to vote with the Republicans. So if the Democrats still controlled the House, they would have all voted to overturn it, right? So it wasn't about voting for what's right and wrong. It was about voting for what's politically expedient. And that's kind of where America is today. We're no longer talking to each other. Both sides of the spectrum literally dislike each other. I mean, it's almost like 1865 all over again, where a civil war's taking place. And that's what my book is about how neither side can win, neither side can fix the problems. So it doesn't really matter who wins. America is basically going down this road of change. And so what's going to happen in America, and I wrote another book called The Path Forward. So you want to read both of my books. And The Path Forward explains where America's heading. And it's not about political answers. Where America's heading is basically fragmentation. And it was interesting, when I was in Canada almost last week, 2 weeks ago, last week of January, I talked to a guy in Canada, and he was telling me that Saskatchewan is trying to split away from their main government. And that's what's going to happen here, is that we're going to have states that basically start to ignore what, on the national level. They start creating their own laws and ignore the national laws. For instance, the CDC laws that they put in place, stuff like that, they're just going to ignore them. Regulations they put in place. For instance, Texas will start ignoring like EPA laws. And then if the government tries to fine the EPA, they basically say, get out of here. We're not listening to you anymore. So I don't know when, that's what's going to happen over this decade, is we're going to start to see fragmentation. And then states will probably group together. So you'll have California, Oregon, and Washington form a group, and they'll have their own political union and their own laws and their own money. And so, yeah, so we're right now, on a national level, our national political system is in the process of basically disintegrating, if you will. It's just a matter of time. It's so obvious, right? I mean, look at our educational system. We have the same educational system in every city in the country. And yet we're seeing more and more how it's failing. And so the states are basically going to say, screw this. We're just going to create our own educational system. We're going to fix this problem. Homeless is another issue, right? We're going to fix it. It's not getting fixed on the national level. We'll fix it on the local level. We're going to go it alone, kind of thing. So that's kind of what we're going to see politically. We're going to start to see fragmentation. You're going to start to see, I'll give you a perfect example. I mean, I would bet that the ratings for the Biden State of the Union address was very low, that basically none of the Republicans watched it. And that's where we're at today, where people are ignoring our president. They're ignoring the politicians. They're ignoring the mainstream media. I mean, the signs are everywhere. The signs are on the wall that what's happening here, that America is not going to fix its problems. And so if it's not going to fix its problems, what's going to unfold? What's going to happen? So you can read my 2 books, and it'll give you some really good insight of what's going to happen over the next 10 years. Great last question.
Well, Don, as always, we appreciate your time. You're an excellent guest, and you always take the time to answer everyone's question in full, and you're not afraid to answer any of them. We certainly appreciate that and your wealth of knowledge in and out of the sector. It's always good to have you, so we appreciate you coming back.
All right. So, hey, let's do this again on Friday, March 25th, or is it 4th? That Friday. It's either the 24th or the 25th, because the 22nd is when the Fed meets and is going to raise rates. Okay.
You got a deal. I'm going to put it in the calendar.
That's awesome. That's going to be a fun show, because I really believe that's going to be the shift point right there. If it isn't the shift point, we should be, we're going to get a lot of data between now and that Friday. I'm going to put it on my calendar too.
Right on. It feels imminent. Well, thanks, everyone. Thanks for all the listeners. Thanks for all the great questions. Thank you, Alex, for co-hosting with me, and we'll see you all next time. Thank you again, Mr. Don Durrett.
Thank you. See you guys.